Hey, 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 mi gente, what's good with you? GizzyCredit aquí resolviendo. Gonna have a good time today. Podcast. Thank you so much for those of you logging on. Don't forget to like and share the video. Thank you so much. Shout out to everyone coming in. Hello. Hey, hey. Why isn't this showing live? Anyways. Hey. Hey. Yes, sir. Let's go live on YouTube, on Facebook. George, what's good? Hey, hey, hey. Let's go right here and say, let me pause that. Hope all is well with everyone over here on Facebook. Hopefully everyone has enjoyed their weekend. We are ready to schedule this and let it go. We gotta let it go. We gotta start it off. I hope everyone is doing well. I'm gonna call John right now. Shout out to everyone tuning in. Thank you so much for liking and sharing the content. Appreciate you much. Okay, had a lot of phone calls with John. AT&T, Verizon, everybody's having problems. We're not having problems.
Hello.
What's up, Jay?
Hey, what's up?
My people on YouTube, can you hear John? John, say hello.
Hello.
Hello. Hopefully everyone could see that John and I, we both have AT&T. I'm in New Jersey. He's in Florida. No bad connections.
Is there a problem with?
Oh, yeah. You see, John is a workaholic. He doesn't know anything that's happening in this world right now. John.
Other than the market-related stuff.
Other than market-related stuff, because he's a geek in that area, but he doesn't know that T-Mobile is totally down. They had an outage or whatever. You know T-Mobile sucks. But nothing worse than Sprint. That's for real.
And they're both, well, I guess they...
Aren't they both owned by each other? Or don't they merge?
Well, I think they're still trying to finalize the merge. I don't think it's finalized yet.
John, when I left Sprint back in 2013, and it was all because I used to want to work in the Jersey Shore at the nude beach, because I go to the nude beach in the Jersey Shore, the North Beach in Sandy Hook, and I wasn't getting reception. So I said, nah, I can't have this happen. I was with AT&T. I mean, I was with Sprint, and then I switched over to AT&T. And with AT&T, I've been on since 2013, 2012. But I kept the same phone number since like high school. But now my Google Voice number, I've had it since 2008, 2009. The Google Voice number that you guys always call me or text me on, that's the number. Anyway, shout out to everyone. I got 4 people on my Facebook business page, which if you can't see me on YouTube, you were able to see me on the Facebook YouTube business page. Thank you so much for following there. The First Generation Project, let's go. What's good, guys? Yes, what's good, Gizzy and John? Ready for credit news. Ready for that work. So these people are excited to hear John. And I'm excited too, because all we're doing around this Rona protest stuff that's going on is keeping you up to date with how you can navigate with your finances, with your credit. What can you do? What to expect? No rumors. This is all factual stuff that's going on, so you can stay educated and tell your friends to tell a friend about this education that you're getting on YouTube for free. Thank you so much for all the people who started credit repair this past weekend. John has been working hard. Right now, I'm going to give the floor to John because the topic of discussion is what's going on with these interest rates. How does the interest rates impact you? Now, the thumbnail that you see the 30-year. You sent me that picture, John. 30-year FHA. What is it?
It's a Freddie Mac. It's Freddie Mac who purchases a lot of the mortgages. They're one of the largest. Fannie Mae, Freddie Mac, Ginnie Mae, they're the biggest mortgage purchasers. So they're the ones that ultimately buy them from.
And if you see that from the 70s, the interest rates have gone down low. As a matter of fact, me and John were talking today how interest rates have gone down much more than what they were supposed to go down. But I'll let John take over and just say thank you so much for everyone on Facebook and YouTube. And let me see who else said something here. Brandon Houston, John and Gizzy changed my life. Thank you, Brandon. You already know. All right, John, take it over.
Right. So, last week we touched on one of the things in the cast we had last week. We talked about was
we talked because we had a customer contact us. He started credit repair, but then his wife wanted to stop the credit repair because she wanted to go and purchase a home with him. The problem with her is that she had $290,000 in student loans. She doesn't want to wait for credit repair. She thought that she thought that whatever rate that was for last week, that it was like, oh my God, I got to do what I got to do ASAP because these rates are never going to be this way ever again. The next thing you know, they go down. Go ahead, John. Sorry about that.
Right. No, but that's what we talked about last week. So we were talking about the fact that, all this kind of, you talk to a mortgage guy, obviously that's kind of the sales kicker, right? You want to lock them in now, rates are blah, 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 blah. But the reality of the situation is rates have been humming around in the same range since, the bottom of 2010, right? I mean, we've been humming in the low 4s down to the low 3s. I mean, I think last week when the market bottomed, the day that it dumped out 1,800 points, you saw the rates go down a hair under 3. Now, if you go back, anybody's been following us every week, I had said at the beginning when Corona first started that, they're not going to be able to get rates much lower just because of the fact that, there's a servicing fee that goes to the banks that are servicing on this. So, for instance, when Chase Bank opens up a loan, or you take out a mortgage with Chase Bank turns around and sells that mortgage to Fannie or Freddie, right? Or Ginnie Mac. That's who purchases. They bundle them up. They sell them the mortgage-backed securities that they get bought, or to sell the direct mortgage to them, right? So what they do is they service it on the front end. So they originate it, they'll service it. They charge typically 75 to 80 basis points, which means 0.75 to 0.8 of percent of the payment goes to them. Right, they get a certain percentage for servicing it, right? And as a result of that, what ultimately ends up happening is they end up doing all the legwork for Fannie and Freddie. But over the course of this particular client of ours, she was concerned about the fact of rates going up, and the fact of the matter is that we sit in an environment like we're in right now, as far as economics and stuff. I mean, there would be no justification behind rates going up. But let me tie back because I didn't finish my thought before. So they charge 75 to 80 basis points on the interest rate. So the rates can't go much lower because if you do the math and you base it off an adjusted inflationary number, if you figure you borrow at 3% from Chase and Chase is charging the lender, 80 basis points, the lender actually nets approximately 2.2% that's going to them. Now they try to stay above an annual adjusted 1.5% as far as the return. That's even a light return. So when you start getting up and you start backing out for taxes and such, when you get around very low 3s, you're running out of room to cut that rate even more, right? And then it stops being profitable for Fannie to want to buy them, and it stops being profitable for the banks to want to take them on and even expose themselves to risk, because all the risk sits on them at that point. You're borrowing for free. You literally borrowing. Even at 3%, you're effectively borrowing for free, right? It's very cheap money, and that's where we stand right now. But the reality is that if the only time you're going to see rates really tick up significantly, if you go back to 06, 07, when the market was there was so much money flowing around the system, I couldn't even, the people that weren't around then, I can't even explain it. There was people that had a lot of money that had no business having a lot of money. Most of it was through lines of credit and, these hellacious size unsecured lines of credit that they were just floating around everywhere. And as a result of that, we ran into issues. But even at that time, it was a situation where mortgage rates were like 6.5%. And that was considered low at that time. Then post that collapse, which was like 08, 2009, 2010, bottom, depending on who you ask, sometime in 2009, 2010 at bottom.
Yes.
When it bottom, we came out and it was in the low fours. And it slowly has tracked lower over the course of time as the economy really has just kind of, as an economy, we're not technically growing. I know the GDP number last year was fairly good, but we're not technically growing. So, for the purposes, and we're not in a position where we can take on, a higher interest rate. In a standard economy, normally speaking, okay, in a normal functioning environment where the Fed isn't totally, trying to plug every hole on this boat, right? Which is effectively what's happening. We have, it started the end of last year. It's been going back since 08. They had to do a lot of printing and a lot of manufacturing that really disturbs a true free market. So now we're in a situation where they're constantly, even to today, they're having to insert themselves and provide backstops of liquidity, which obviously causes problems in the broader market. And as far as interest rates are concerned, it makes the situation very difficult for them to raise the interest rate. So I think I think that what's going to ultimately end up happening is we're going to continue to track lower. But let me just give, lower being like 3%, but let me just give you guys a point of comparison before we get into a lot of the specifics. So if you think about it, when interest rates back in, you had referenced 1970, I think interest rates got up as high as like 20%, right? When mortgage interest rates are as high as 20%, right? That means all the rates are higher. That means CD rates are higher. That means savings account rates are higher. That means, just money market account savings accounts are higher. So in essence, when they're at 20, you're theoretically going to see a CD. And for anybody that's not familiar with what a CD is where you put money with the bank. Effectively, what happens is, you have terms on it, but, they're turning around and lending it, but in essence, they're short term. You get paid a guaranteed interest rate on that money. You can have a year, 2 years, 3 years, 4 years, etc. It's like a savings account, but you just can't grab at it. You can't take from it. It's got to be holed up. Back then, you're talking about situations when the mortgage rates were at 20%, CD rates were at 25%. So if you imagine if you popped $1 million at a bank at 25% on a 1-year CD and you get your yield 25%, at the end of that year you walked away with $1.25 million. That's insane. Right now the CD rates are like 1%, right? 1.5%, some ridiculous like that, depending on how long you're tracking it out, right?
Correct.
The longer the term, the lower the interest rate, the shorter the term. I'm sorry, the longer the term, the higher the interest rate, the shorter the term, the lower the interest rate. So just as a think of, so now we're sitting down here at very low interest rates.
You're cutting off, John.
You hear me?
I hear you now. Yes.
I said, now we're sitting down here at very low interest rates. The interest rates being what they are, and the savings rates and the money market rates and all that stuff, they're absurdly low, right? I know last year when people were, complaining about money market rates and stuff, I know that I have the fund that I run it's run out of Vanguard, so they had a settlement fund that was at 2.4%, which is great, and it was like double. I don't even know how they were able to provide it, but whatever the case may be, there was double what you would get in a normal institution. Most institutions were offering half of that. So you're literally you're giving your money to them to turn around and lend, and they're giving you back 1.5%. It's insane. It's beautiful for the banks, right? It does nothing for us as the consumer. So we get to borrow low. It forces you to go into areas of higher risk, right, with your investment. It forces you to go into the stock market to get return. It forces you to go into the real estate market to get return. You have to take higher risk areas in order to get a return that's commensurate. Buy bonds, things of that sort, right?
Yes.
Things that most people's natural risk appetite just does not include. Right? But they've been forced to have to include it, which is why you see in the stock market and mutual funds and all these things, market related, are the flows of capital are so much higher now than they were 10 years ago, 15 years ago, because people that were, obviously people are putting more money into 401s, IRAs, etc., but they're not getting the returns from much more standard, simple investments that would otherwise use in the past. If somebody told you, look, I'll give you 15%, I'll be able to get you 15% in the CD for the next 5 years every single year, or I can put it in the stock market and I can get, I can try and get you 15%. What do you think someone's going to say? There's people that want absolutely no risk with their retirement money, right? They don't want to have it exposed to any risk. They plop it in that CD and they leave it. The problem is they don't have that luxury now. So now because rates are so low, all rates are low.
Yes.
See, rates track each other, right? So as rates go low in certain areas, you're going to see it in other areas because they're tied to Fed fund rate, and they're tied to all the rates that the Federal Reserve is actually controlling. So as a result, you're forced to go into the market. You're forced to go into bonds. You're forced to go into all these other areas, whether it be fixed income or return, where you're exposing yourself to more risk. And even bonds don't return. I mean, bonds are terrible. You're tracking about the same that you would. I mean, A-paper bonds, corporate bonds are like, 2%, 3%. I mean, it's great for the companies because they're borrowing at 2 or 3%, right? But for you as the investor, it's awful. I mean, it's not a situation that you want to really expose yourself to because most people aren't familiar with it. So when it comes to, the idea behind raising rates, though, and I really want to kind of bring this full circle, and I hope I'm being clear about it. In a normal functioning market, this was the point I was making earlier. In a normal market, interest rates, right? And to do that to prevent bubbles, right? So, for instance, when you keep rates really low for a long period of time, bubbles build up. Bubbles build up in real estate because they're borrowing low, and it's obviously people run for that opportunity because it's low hanging fruit at the time. Bubbles will develop in the stock market, much like they did over the last couple of years, right? We just had a bubble burst at the beginning of coronavirus. That is at least the stock market, right? You lose 30% in the stock market in the course of a month. There's clearly a bubble there. Obviously, there was other variables going into it, but 30% is an extreme amount, right? In a very short period of time with absolutely no specificity at the point. Now, in the normal market, what will happen is the Fed will slowly inch rates up. So what that'll force it to do is it'll inch up all rates. It'll CD rates, it'll inch up money market rates, it'll inch up mortgage rates. So what'll happen is people say, okay, you know what? Now I can get a CD at 4% and I don't got to put it in bonds. Sure, man, you'll start to see people come out of the market, right? And then you'll see the market come back. Right? Yes. The comeback is incorrect. Naturally correct. It's a natural correction. It's a free market correction. You'll see the same thing happen in real estate. People say, okay, you know what? I got to expose myself to this. I'd rather just put it in an investment that's much safer. So maybe they scale back the real estate investment as a result. And you'll slowly start to see real estate investments come back. But at the same time, that's coupled with the fact as interest rates go up, okay, people can afford less.
Yes, right? That's true.
So what ends up happening is when you consider that the interest rates go up, money come out of the stock market, go into perspective, you'll see this thing happen in real estate. Truly forces the real estate side of things is the fact that as interest rates go up, let's say you're borrowing at 3% before, and now the rates go up to 5%. We'll do the math. At $100,000, at 3%, your payment's roughly $300, right? At $100,000 at 5%, it's $500. If you're tight against your debt to income ratio, that's going to lower the amount you can approve to stay at $300. So now that same person that was, at 3% could buy $100,000 at 5%. They're basically buying, $60,000 to get the same number, to get the same $300 payment. Okay. So what that ultimately ends up doing is it ends up slowly over time, or, gradually evening out that bubble, right? So you get natural, slow corrections.
Okay.
And this is what you have to do in a healthy economy, right? A healthy economy is not something you just runs like a hockey stick all the way up.
Yes.
Because there needs to be a flow of exits and entrances at the right prices so that you don't have an abscess in certain areas, which is going on in, our economy over the last 10 years, right? Just an abscess where values just keep going up, but you're really not making significantly higher highs in values. You're just having churn. Churn meaning things aren't really going anywhere. There's buyers that are vacating, sellers, etc., and you're staying in the same consolidation, and you're inching up a little bit, and you're coming back, and that's basically where the market was for the course of the last, almost all of last year. In the real estate market, depending on where you're at, you probably already have seen it top out even before Corona presented itself, right?
Yes.
So you saw a lot of markets that already had that happen because people were already seeing that it was too high, and because rates are low, you weren't seeing the natural correction that you otherwise would, right? So as a result of that, with Corona now, this is another reason why I feel like it's going to correct, but not that I think interest rates are going to go up, but you're going to see, people be smarter about buying, right? You're going to have a natural understanding of where values are, and people are just going to be much more specific in where they want to buy. So I just think that the more people can understand why interest rates will go up, but don't just listen to your mortgage guy. That guy's saying that because he's trying to push you into a deal. The reality is, the difference between 50 basis points. So let's just say, for argument's sake, you locked in your loan last Monday. When we were on Monday, I think the rates were floating somewhere around 3.3, 3.4. And when the market tanked on Tuesday, Wednesday, at the low, they got down to around 3, maybe a hair under 3. So you're talking about roughly 35 basis points. Okay, 35 basis points on a $100,000 loan is like $30. So on a $300,000 loan, it's $90, right? Money is money, right? But the fact of the matter is that, you know, that fluctuation could easily get washed out in another way. So, I mean, don't get rushed into, don't get forced into anything knowing that you're going to sit in a certain range of these interest rates. Not going to get up to 4.5% interest. It's not going to happen, right? There's just no way. The minute, if anybody wants to cross-reference, just go back to October of 2018 when you saw the market completely collapse going into Christmas when there was the government shutdown.
Yes.
The Federal Reserve raised interest rates, okay? He raised interest rates. And as a result, the market is so sensitive to raising interest rates. Not did he very course at the meeting, but then he cut it 3 times last year. Just to get it back down to a point of comfortability for the overall market because it's so fragile. An interest rate rise right now is in an economy that's not even open.
Yeah. So what also happens with the stimulus money and so much trillions of dollars being out there? Does that have anything to do?
Then you get to a point where ultimately, and we talked about, and I brought this up before, ultimately you can get into a situation where they're going to have to raise taxes because they're not going to be able to raise interest rates. Right, so it's just not going to happen. Not anytime soon. Not in this kind of a situation. Right, we keep putting a Band-Aid. We keep putting a Band-Aid on a wound that needs a stitch. Right, as an economy. So we keep plugging the hole. But the problem is that the issue that was there originally didn't ever get rectified. Right, we just printed our way out of 2008. And here we are now. They know they can't just let it go because it's a boat that has holes in it, right? So they're constantly plugging it. If you guys, I don't know how close everybody listens, pays attention, but at the end of last year, there was a really big overnight repo problem.
Yes.
Where the Fed had to inject $60 billion.
Yes.
Now, it wasn't that quiet, but it was a pretty big deal when banks aren't able to cover their overnight obligations and the Fed has to come in and backstop them. That is completely out of nowhere, right? I mean, there wasn't anything that triggered that. I mean, you start seeing a situation where liquidity becomes a problem among these banks, overnight liquidity. You ask yourself, how is that possible? And it's because there's these areas of the economy that just aren't running free. It's a free/manufactured environment with a Fed much more inserted in it than it ever was. And when we run into problems like we're in right now, they're just everywhere. Like today, they announced they're buying personal corporate bonds, which I'm not even sure. I don't even understand what they need to be in that for. I mean, I don't know why they don't just come out and say that they're handling it like the Chinese, and that the Chinese government comes in and just buys up everything. They buy our Fed now buys ETFs, they buy corporate bonds, they buy personal bonds, they buy, I mean, everything they're buying now to provide liquidity to the market with 0% interest rates. I mean, there's nothing more that they can possibly do short of saying that they're going to start buying equities. If they come out and say they're going to start buying equities, then everybody that listens to this might as well just start buying equities and just close your eyes, because at that point there's going to be, that basically means any significant dip. It's like buybacks for a stock. They're just going to soak it all up, and you just keep buying and buying and buying. You have to stop endlessly. I mean, if that ever comes a time when that happens, whether it be loud or subtly, everybody should just get, at that point. I mean, you have no risk. Risk has vacated from the operation. So I don't know if they're doing this now because they anticipate another problem, and that's my guess, right? I think they're anticipating there to be another downturn, and as a result of the downturn that we may see as a result of maybe new cases or any number of things that go on, maybe a combination of things.
Jobs not coming back, you think?
Say that again?
Jobs not coming back because of social distancing?
It's a multitude. Yeah, exactly. It's a multitude of things, right? And the other fact of the matter is that they've already said they're not closing the economy again, right? So you're gonna have if there's another run here in some states on up in coronavirus, you're gonna have people that aren't gonna want to go out. But along the same lines, I mean, you're gonna have companies operating at 50% capacity when other ones aren't even open. You understand what I mean? Like, there's a lot of people who still won't leave their house as a result of the stuff, especially in the northeast quadrant in this country. So, like, if you think that they're not going to close it down again and they're not going to do a shelter in place, and you're basically going to be out there on your own whims, which I don't think is a terrible thing. I'm just saying that from a business perspective, which is all that the Fed cares about and the stock market focuses on, that's not going to translate to dollars, right?
Okay.
That's not translating to dollars. And I got news for you. All these, not that I don't think it's in absolute for the right reason, right? But like disbanding a lot of these police departments is in inner cities and cities is. I read an article today that said that you and I talked about what Minneapolis.
18%. There was
18% of the houses are for sale.
18% of the houses in Minneapolis for sale.
You're starting to see that stuff prop up everywhere because people are concerned that they're going to become targets, right? Because nobody knows what a policeless society looks like, right?
Yeah.
So there's just so many variables that are going on right now that are working against the grain, right? So you're seeing the Fed do so much to prop things up. One of them is not going to be raise interest rates, right?
Correct.
Because you raise interest rates in a good environment. When asset prices are highest, the economy is strong, everybody is employed, employment's low. I mean, literally at the last meeting, which was last week, the Federal Reserve Chairman said, I'm not even thinking about raising rates. I mean, you can't be any clearer than that in an environment where they typically speak tongue-in-cheek. So if he doesn't raise interest rates, those mortgage rates are going nowhere. They're gonna sit in a very tight range and bob back and forth, in that very tight menial range, which will probably range between 3.5 roughly, they give or take, and bounce there until it's not going to leg much lower, but it's not going to go higher. And as a result of that, we're going to get, we're going to see what we've seen for the last 10 years, 12 years, where you're not going to get any return on your money markets, your savings accounts. You're going to be forced to go into the market, which, look, if the Fed's backstopping it, it's not the worst thing. You start to extract some risk from the situation. This isn't me telling everybody to go buy stocks right now, because I'm not saying that. I'm just saying that, in a situation where our rates are this low, the best show in town is equities. I mean, it really is. It's the only show in town, quite honestly. I mean, if bonds are yielding you 2.5% on a fixed income side, that means you're making 2.5% annually on your money, right? And the S&P, if you bought it that year, it was up 7%. Just do the math, right? Now, obviously, there's a lot more risk involved there, and people should do the research on that stuff. But I'm just saying that there's not many other options. There really isn't. And real estate is sitting in a situation where a lot of people, much like myself, are convinced that it's going to be going down as a result of all the variables we've talked about for other reasons, even with interest rates being as low as they are. So I mean, the one way to keep yourself exposed and still get return is through the market. So I mean, but I just think that for all the other reasons with the rates, like I was talking about, for the interest rates and stuff, I just think that for anybody to think they're going to be going up anytime soon would be crazy. It would be crazy.
Yes.
And it's just not going to happen. So I mean,
if people are fixing their credit now and they're thinking 3 months to 6 months, I could buy a house, would they still be able to get a deal, or do you expect the property values to keep going down?
No, because remember, it's a slow unwinding, right? So for instance, I'll give you a point of comparison, and I talked about this before. So let's just say in 2008 is when the market crashed last time, right? That's when the actual stock market tanked. It was in like May of 2008. Okay, that's when the first fault line broke. And then it continued to bottom itself into early 2009. I think it bottomed out February or March of 2009. So you're talking about a good year of just maybe 8-9 months of the stock market tanking, right? Just rolling over, finding bases, rolling over, et cetera, right? Couldn't find a footing. The real estate market felt that well into 10, 11. I mean, some areas, it honestly, you go in some areas, they really didn't show an appreciative year until 12. So you're talking about, it took a couple years for it to find a bottom. Now, that was a little bit different, though, because of the fact that a lot of that crisis was based on foreclosures, right?
Yes.
So if you discount for that factor, and you discount for the fact that it was a large reason that it lasted so long, is because, you're trying to dispose of assets that are foreclosed on, and that was the crux behind a lot of the issue. Then you say to yourself, okay, you know what, maybe 4 years is extreme, right? Maybe you cut that in half, you scale it out, you discount it, you handicap it, you say, maybe a year, year and a half, 2 years, somewhere in that range is probably real. So if you figure that this probably sparked itself February, March of this year, I think that you could easily see things slowly unwind at a comfortable speed and asset prices reprice and By that time, we'll have a much better idea of who's going to survive economically speaking and who's not, what businesses are going to make it, which ones aren't, which airlines, by the way, are going to make it, or which ones are going to be forced to consolidate with the other ones.
But by when is this? By when is this, you said? The end of the year?
I think the end of the year is some opportunities, but I think probably early into next year, because I think towards the end of this year, I just think the consumer sentiment is going to go down. I think it continue to, well, it's down already, but it's going to continue to go down, right? Because people are going to come out, of this situation. There'll be a lot of jobs that aren't going to come back. Everybody knows this already. They've already come out and said there's a lot of jobs that aren't going to be coming back, and that even ones that have already come back that are running out of money are saying that they're going to have to lay people off again. So there's going to be another round of a spike in unemployment more than likely, which is going to keep people down, right? It's just the way it is. And if it continues to linger around going into the winter months, especially in areas where there's not a lot of sunlight and they're stuck inside and the days are short and the nights are long, you're just going to, in an already fragile psychological area, right, or areas, you're going to run into a situation where there's just not going to be people running out the door trying to buy things, right? It's just not going to happen. If anybody that understands real estate knows that in most markets that aren't like California, constantly drenched in sun, the most prolific time to sell a house is typically spring into summer, right?
Correct.
That's typically maybe a little run over from there. That's your busiest time of the year, not going into the seasons, right? Not going into Christmas, not going into the New Year's, right? Because that's when people are saving, they're spending on Christmas, or they're saving up for whatever trips are going to go on.
What's going to happen this year, Black Friday? You see how, you remember how Black Friday used to be? Everybody crammed together, going into, it's not going to happen this year.
I mean, look, I'm a firm believer of the fact that, when you manufacture a market like we're doing right now, things like this happen and it does it itself because there's still a freedom to the market, right?
Yeah.
So as a result of the things that are going on right now, there's things that the Fed can't control. They can't control unemployment. They can't control people's consumer sentiment and their willingness to go out and spend. Now everybody's spending right now because they got their stimulus check, right?
Yes.
People are getting more on unemployment than they did before. So you're still seeing things at the very opening of this economy again. You're still seeing things happen, right? People going out spending, and every restaurant guy you talk to, regardless of the size, will say, yeah, we're running about 50% capacity.
Correct.
Which 50% is nowhere near 100%. And they can't run 100% because they're not capable of doing, because they can't put enough tables in there anyway. But some areas are inhibiting them from even operating at a higher percentage than that, right, or capacity than that. So based upon how the virus is moving around. So, when you're dealing in a situation like that with just so much uncertainty still, and then you add in some other factors like maybe it starts to spike back up, and maybe, you're starting to add in other variables into the situation, geopolitical, economical, et cetera. You're just running into a situation that and look, I think, and I've said this before, I don't look at this as doom and gloom. I look at this as being a good opportunity for people that have been waiting for a good opportunity to get in. So,
correct.
There's going to be good opportunities, I think, and as a result, the rates will still be low to tie this all together. I mean, you're still going to have low rates. You're still going to have opportunities to buy a cheaper house at a lower rate, which is even better, because imagine if a house you're looking at right now is $300,000. 8 months to a year, that same house is on the market for $240,000 at the same low interest rate.
That's right.
That's a beautiful thing, right? I mean, normally when you see values come down, it's like I explained before, it's as a result of rates going up, right? Which forces the value down effectively because people can afford less. In situations like that, you're still netting out the same payment, right? But in situations like this, with the rates being low and it just being, in my opinion, a natural correction that's going to happen as a result of everything else that's going on, you'll get a cheaper house, and you'll get it at a cheaper, your payment will be cheaper. It'll be dollars to donuts for what you're saving. I mean, you're saving $60,000 on the purchase, and effectively, in the scenario I just gave, you'll save $200 on the payment. So I mean, it's a win-win either way. So it plays out the way I anticipate it to play out.
And that's just the purchase, but I have today Greg Williams from Baltimore that we helped him buy a house. He called me. He says, is it a good time to refi? And I asked him when he bought his house, and he said, it was 2015 the last time we helped him, and he was able to purchase his home. So it's been 5 years, and he has a 5.375 something, he says, interest rate.
That seems like a high rate, even at 15. That seems like a high rate, but okay, that's fine.
I told him to email us. We'll let him know if he could do it or not.
I mean, I would say if he's saving 200 basis points for sure, but I mean that seems like a really high rate for 2015. But either way, yeah, I mean, I didn't see an email from other than
no, he called me.
To hold off today or something like that, but I don't know. But yeah, I mean, I just think that I think that and look, the great thing about all this stuff is that we've been talking about this like the week it started, right? Like all this Corona stuff and all this fallout. So, we've been talking about this almost weekly in so all the things that we're kind of anticipating and discounting and handicapping going forward, it all has all really been documented. So it's not like conjecture, it's not speculation, like you said earlier. It's not based upon rumor or myth. It's stuff that
correct.
You're actually, if you've been listening to us the entire time, you've seen a lot of that stuff play out the way we talked about, the way, and you'll continue to see it play out the way we talked about. Now, unfortunately, I can't guarantee the real estate prices are going to go down. I can tell you based on all my experience, based on all the other factors, and if you put pen to paper and you do the numbers and you say you're running a 20% unemployment rate, you take two buyers out of a 10-person buyer pool, and the other 3 people, right, are collecting unemployment, but they're technically employed to make sure if they're coming back, so that 20% number can become 30%. And the last thing they're thinking about is buying a house. So you literally just cut in half your entire buyer base. You explained to me how real estate prices are going to go up. Now, right now, things.
Well, now you have these renters who were in Minneapolis, and they're like, I'm not staying in the city. I gotta go and buy in rural suburb areas.
Well, that's kind of that's what's going on everywhere now. So people are getting out of cities.
Or you have a business owner who lost his business or can't open. He needs to go to a state where he's gonna be able to put up shop and start working.
Yeah, I mean, but at that point, if you're relocating, you might as well find a place where that you want to be, where the taxes are right and everything like that, right? Because you're being forced out. But we talked about all this kind of transition stuff in the one podcast after the Ryan a couple weeks ago, right? So yes. I mean, we got into all the specifics and about people. Now the mindset is to transition out of the cities and get into the suburbs, and that's the focus, and that's what you're seeing in Minneapolis, which is an extreme scenario, but you're going to see it over the course of time in the other ones. And it's not hard to really discount and handicap a lot of this stuff, right? So it'll spike values and what buyers come out. You'll see obviously a more concentration of sales in the suburban areas than you will in the city areas, but I mean blended, you'll see opportunities over the course of time, and it'll slowly work itself out. I mean, I think
but even in Florida, Jay, you in Florida and Orlando, all those what is it, Disney, they're gonna open. How are they gonna practice stuff? So are you willing to bring your kids? You know how kids touch these rails and there's all these germs, it's all over the place.
Yeah, I mean, look from a I'm not a scientist or a doctor, but I can tell you that down where we're at, I'm in Southeast Florida, right, in Palm Beach County, and everything is wide open now. I mean, like I said before, it's wide open. I mean, I don't know anywhere that's closed. You can go out to dinner. You can sit down and eat. I mean,
yes,
it's completely back to normal. You don't have to wear a mask in the restaurant. You can just the servers obviously wearing it. They took all these precautions as far as menus to make sure people aren't touching things other people are touching. But what you're seeing, which I think is great, which the people aren't getting enough credit for, is that you're seeing people still choose not to. People are still cautiously optimistic. You understand what I mean?
Yes.
You don't see people just running out being morons, contrary to what the media says. Every time you turn it on, that everybody in Florida and Texas, whatever, Georgia, are just running out like idiots. Just germing each other up left and right. Unfortunately, I'm down here, and that's not what you're seeing. You are not seeing restaurants overwhelmed with people. You're seeing some people go. Most people aren't. Most people are still doing takeout. People aren't 100% crazy about it, but at the same time, it lends to what I said earlier about in an earlier podcast about if people are going to come out of it, it's going to be gradual, right? I mean, a very small percentage of the population in our country are like, you know what, F this, F that. I'm just going out. I'm not dealing with this. I don't care.
Oh, yes.
Some people, but it's a very small percentage. I mean, I give that 10-15% of the whole population. The other 85 are taking it in varying degrees of seriousness, right? But still taking it serious, right?
Correct.
It might be light serious to extreme. I'm not leaving my house ever without gloves, a mask, a helmet, the whole shebang, right? The whole costume. So I think I think with that, that's going to put more pressure on a lot of these companies. I mean, we're looking at it like it's a victory thus far, as places, restaurants being open or running at 50% capacity. But that's not a victory, And the question is, if they're running, they continue to run, retailers, things like this are running at, let's just say for argument's sake, they're in the same boat and they're running at 50% capacity. What do you think that does?
Yes.
I mean, if that happens, then you're going to start to see situations where retailers got to start dialing back. They got to start laying off because they're not making as much money. It's all about that bottom line, right? So they're going to bring people back initially, but if that doesn't turn into a money-making operation, you're going to start to see people cut, and then it becomes a domino effect. And again, it goes back to, like I said before, a true repricing and resettling of assets that we haven't seen as a result of the interest rates going up, right? Because when you naturally raise interest rates, it affects the entire economy.
Yes.
And that's how the free market is run, by interest rate going up, interest rates going down. It wasn't until 2010 or 2008 when the market collapsed last time that we started getting into quantitative easing and all these other manufactured variables into a broader economy to help keep it propped up, because we needed it at the time. It wasn't just the consumer that propped it up at that point. The Fed had to come in and do all these extraordinary things in order to do it. The problem is the Fed couldn't leave. They tried selling the bonds that they were buying and stuff like that. And when they started doing that, extracting liquidity from the market and wanted to raise rates was the end of October, or was the end of 2018 when the market tanked again. So it's such a delicate environment. There's no way rates are going to go up. There's no way. And who knows if we get back to a point where we're in a high interest rate environment again. It's very difficult to foresee right now, just because you'd have, in order to be able to get into a high interest rate environment, you'd have to envision a time when the Fed would have to be out of the propping up of the market. And I don't see how that happens.
So people are emotionally attached to wanting to get something ASAP right now. If they got like a deal and they're looking at, they're listening to their mortgage broker, telling them, yo, this is what you got to do now. Like, you got to lock in this rate because you never know, the rate's it's gonna go up one of these days. I mean, that's just so bogus.
But again,
it's uneducated consumer.
What's that?
It's an uneducated consumer not knowing how things go.
Well, I mean, how would anybody understand what that means, right? If you're not in that business, that's why we like to do this stuff. How would you even understand? Right? What point of reference would you have? You don't know. The average individual doesn't understand what controls mortgage interest rates or what generally drives mortgage interest rates.
Yes.
I mean, if you really want to narrow it down, the 30-year mortgage interest rate almost mirrors identically the 10-year Treasury. So if you want to know where, in any given day where mortgage rates are going to be, look at the 10-year Treasury bond and see where that goes. And the associated rate, and that'll give you a good idea. They almost mirror each other. That'll give you a good idea whether the rates are up for that day or down for that day, and that'll be your way of telling if rates are up or down for that day. But I can tell you, it's not, and there's a floor certain to that, right? Like when the market tanked in February, March of this year, and the 10-year got down to like some absurdly low number, there's still a floor that rates hit, which is the floor I keep impressing every single podcast, which is right around the high 2s, the low 3s. It's going to be very difficult for them to breach that, for the reasons I explained earlier in this, just for general reasons, because then it stops being economical to own it as an investor, right? I mean, the risk lies solely on the Freddie and Fannie at that point. There's no real risk to the consumer at that point, right? Because they're borrowing at free money, and there's just so much money being pumped out at a 2% rate after you pay off the servicing. It's very difficult with inflation kicked in and taxes, et cetera. So I just think that it's going to be very, very, very difficult. But at the same time, how would anybody know that, right? Like, yes. I mean, I'm sure I'm trying to explain this as clear as I can, but I'm sure I've confused people in explaining it, right? So,
of course, yeah. This is not this is not things that you can just. I mean, you got to go through finance, in college, and see.
But this is something that we at least with the amount of time that we allocate to this thing.
Well, where are countries right now that have 0% interest rates?
They have negative interest rates.
So how does that work?
There's countries that have negative interest rates. That means technically speaking, and don't ask me how it works because it's not in our country, and I don't invest in Europe, and it's in Europe, and I don't deal with that. But literally, the rates are negative. They're not almost negative; they're negative. So, your borrowing rates are negative, and in effect, in theory, you would get money back for borrowing. Now, that's not how it works, obviously, but the fact of the matter is that they're negative. A lot of the European Union is negative, and that's why you see our country trying to avoid having to do it, because it's done nothing for them as far as fixing their economy or providing them any slack in fixing the economy. So there's really no point doing it. Not to mention, we're looked as like the leader. You know, people come to the United States to invest, right?
Yes.
You know, you get into negative. The T-bond's supposed to be, the Treasury bill is supposed to be like a brick of gold, right? And in theory, it's supposed to be backed by a large degree of that. But you know, you're borrowing or you're lending money to the United States government. So I mean, when you invest and you get a negative interest rate, makes, you know, it obviously is it's not a good look. And I don't think you'll ever see us go to negative interest rates like everybody else did, no matter how bad it gets. Even at the armpit of in March, rates got real low, but they didn't ever go negative. They got absurdly low at one point in time, lower than I've ever seen, and maybe we'll see for a long time, but they didn't get negative. So I just don't see it happening, but it's definitely there. It's definitely a thing. But anyway, what I was trying to say earlier was just the fact that, you know, that's why we like doing like these podcasts, because it can give people ways of looking at things that they obviously wouldn't have ever looked at before, right? And then they can make their own determination, whether it be buying a car or when you're going to buy a house, try and make a determination on if the rate's really going to go up. So you don't ever have to be in that position where you're the consumer getting taken advantage of. You can be the consumer that knows and makes the decision based on your terms. Right?
Well, here's the thing. I had Angel Garcia contact me today. He called me, and then he started telling me how he went to go get a car, and I'm like, why would you go and get a car for you? Not, you know, you don't run this by us. And of course, he got denied.
So there's stuff that he added in the last month too. So I was just working on it a couple days ago. But go ahead. I didn't know the story.
No, he called me like an hour before the podcast. So I'm like, why would you even try and go for a car? They ran a whole bunch of inquiries, he said. And the guy said, yeah, but you could get this vehicle, and you know, the vehicle that you have now, you just let it go. Yeah, just
let it go.
Just let it go.
Isn't that beautiful advice? See, this goes back to what I said earlier. How is there not any kind of regulation in the car dealership business? How is there not any licensing that you require? A mortgage broker, if you're somebody that's just originating mortgages, you have to have and I think almost every state in this country now, as a result of 08, Dodd-Frank and everything, you have to have a 700 credit score, I believe. They might have adjusted, scaled down. There's not many brokers left, but even if you're a direct lender, you work under a direct lender, that's what I'm talking about, an originator.
Mm-hmm.
I'm pretty sure you got to have a 700 or 680 credit score. How on earth are people out there selling cars with no licensing or any kind of background required? I don't understand any of it. I mean, if I'm wrong, somebody please correct me as far as that's concerned. I know the finance manager doesn't need any licensing. I'm positive about that without question. I've gotten into more screaming matches and yelling at finance managers and auto dealers than I'd like to admit, just because of the fact that they're always trying, you know, there's always that air that goes on there. That's part of the reason why I made it a mission with all the clients to just get approved before they go to the dealers, because I got tired of screaming at these people. Not to mention, you know, in a situation like that, when they're doing yield spreads out of 3%, 4%, 5%, 6%, and you buy a $30,000, $40,000 car, and that equates to $15,000 extra you're paying in interest, and they're walking away with an extra 2 G's at the table. I mean, just look at that. It's disgusting. But the fact of the matter is that you see this across all things that we're trying to teach, right? And again, I want to put a disclosure. Not all auto dealers are bad. We have clients that are good auto dealers, good people. They're not all that way, but there is a very large bad element that exists in that business, and it's one that we try to shield our clients from, right? And as a result of that, it goes with everything. As long as we give people understanding of how it's run and how they arrive at and how it works, then they can make the decision. This is just another example. If you can understand why interest rates do what they do, or how they do what they do as a result of what they do, everybody has a pretty. I mean, you don't have to be plugged into the understanding of Wall Street like I am and be all about it all day, every day, in order to be able to understand. And most people have a pretty good idea where we stand as a general economy. You know what I mean?
Well, you got Glenn Byage here saying privately owned dealership will always try to screw someone over just to make a sale.
It's not just the price. That's absolutely right. But the more like just scenarios in a lot of cases, but there's plenty of big name dealerships too.
Yes.
I mean, just because it's a big dealership does not mean that they're hiring Harvard MBAs to come in there and run it, right?
Yes.
It just means that they got more inventory, they got more capital to be able to buy inventory, grow, et cetera, et cetera, et cetera. So he's right.
So John, but imagine these vehicles doing so bad, and then you got places like Beverly Hills that have Mercedes-Benz dealers and all this place. Have you seen footage of these riders breaking into these cars, putting them on fire? I mean, these.
I haven't, but you're probably working. That's probably helping these dealerships. You understand that, right? Because they have insurance now.
No, that's what I mean. I'm thinking these dealerships, they're going backwards.
No, they're going forwards, man. I mean, that's inventory that wasn't selling. I just got blown up. And
these high-end two-door Mercedes AMG being burned to the ground.
Well, if they do it in mass quantities, it's pretty, I'd start to question who set the fire. But if it's just one-off here and there, I mean, obviously they're going to get insurance money for that situation. Not going to help. But you're talking. That's another thing, man. I mean, and we talked about it. They're giving those cars away at this point. I mean, they're literally giving cars away at this point. I mean, if you got a pulse and you want to get a new car, trust me, there's a way at this point. These dudes are going to get these cars off the lots. Now, I understand there's been I think, if I understand correctly, and I may be wrong, but I don't think I am, I think June's been a reasonable month. I think the end of May was a pretty good month for dealers as far as, nowhere near 100% capacity, but at least starting to have some sort of a semblance.
Well, everybody's getting that stimulus money. They're getting a vehicle, John.
I was just about to say, though, but imagine that stimulus money's gone for a lot of people now. Right?
Yes.
That money was spent.
Yeah.
And the White House just came out and said at the end of July,
yes,
that extra unemployment money or unemployment check is done. You're done. I mean, you're not getting that extra $600 like you did before, because they realized that they demotivated people from going back to work. If people were making way more money on unemployment, they were making work. How are you going to get them off the couch? Right.
That's the problem with what is it? Basic income basic. Universal. Universal income. Like when they say that everybody's gonna get.
Essential. Right. Well, everybody gets a paycheck.
Everybody gets a paycheck. Yeah. Well, Andrew Yang was saying for the. He was going for president.
Well, that's Bernie's a socialist. The same idea. I mean, you're basically figuring out ways.
Universal basic income. There you go.
Right, but I mean, it's the same idea, though. But it's exactly. But look at every other country that has socialism. Look at Italy. I mean, it's not even it's an economy, but I mean, it's an enormous country that much bigger than some of the others. And the economy pales in comparison. Because what motivation? I mean, they got universal health care. They got everything's socialist over there.
Yes.
You tell somebody they don't have to get out of bed to get a check. They don't have to get out of bed to earn their health insurance. They don't have to get out of bed to do this, that, and the other thing. Trust me, there's a large percentage of the population that would be comfortable sitting in bed all day, sadly. I'm not judging anybody, it's just that. So that's what's happening right now. They realize they made a mistake by doing it. I mean, it's what they needed to do at the time, so they're scaling it back. The point I'm trying to make, though, is that you take that unemployment money off the table, you take that stimulus money off the table with no semblance of a new bill coming in. And I was actually listening over the weekend. There was a senator that was on talking, and he was saying, look, any of those big bills that get done, they get done at certain times of the year.
Yes.
He was like, they don't just get done like on a whim. Obviously what happened in March was when they were in session. Right now they're home for the summer. So they were in session in February and March, and that was an emergency. But right now, pumping out another stimulus scenario is not even on anybody's radar. You hear the president, kind of dangling it.
Yes.
But the reality is, nobody in the Senate or the House is talking about it, like legitimately, to where it's on the docket, and they're getting further with it. And you saw how long it took to do that before. So, I mean, that's not coming anytime soon. And when you extract that liquidity and know there's not another dose of that liquidity coming for at least a couple of months, what's going to plug that hole? When that money burns off from, sometime at the end of the summer, sometime towards the end of the summer, coupling with the fact that that's when maybe a lot of these constraints are going to come off, hopefully, all the areas of this country from coronavirus, as far as being able to operate at whatever capacity they want to at that time. I mean, it is going to be a real eye-opener. That's when you're going to start seeing some real numbers, right? I mean, right now, this is all just smoke that you hear in the news and stuff about things reopening, Yes. But I mean, when you get into like the end of the summer, early part of the fall, I mean, that's when you're going to really see who's going to make it and who's not, because that's when that PPP, the first set of that PPP money's running out right now.
Okay.
And that's a problem, right? Because we're still not even in an open economy. So the people that got the money first are now running into a situation, pay it back now, or it's going to be granted, but they need more, right? So, but there's no more on deck. So you're running into a situation where, like, there's going to be a liquidity situation that comes up over the next couple of months. It's all lends to the things I said earlier about the broader market, but it's just something to take into consideration, because, I mean, in businesses like housing, like autos, like large purchase items where you're going to need to finance them and ultimately pay them, people pause to buy them, right?
Yes.
They say, well, am I going to have my job in 3 months?
Correct.
Right? Are you going to have the liquidity in 3 months? Are you going to be able to pull this up? People pause when they make those purchases because they know how large they are and how much they can impact. Obviously going out and getting takeout from a restaurant is not going to deter, your broader life on a large scale, right? Buying a house absolutely will, right? And the uncertainty around your income has a large degree to do with that. The uncertainty around your liquidity position has a large degree to do with that. That's why I'm saying that you're going to continue to see things depending on how things continue to progress over the course of the next couple of months that are going to. They're going to continue to pressure here. It's just so early in this. I keep saying it, I know, but it's true. We're just saying it.
Well, right now I have Miss Divine Brown on YouTube. We want to buy our soon-to-be nephew, our soon-to-be 18-year-old nephew, a car, probably a Hyundai. The spending threshold is $2,000. Is this still good to get it from an auction?
I mean, look,
auction, you gotta be like a dealership to purchase.
No, not necessarily.
I know. Hear me out. What I get from watching Scotty Kilmer channel, which he's a YouTuber, the biggest mechanic shop. He says if you buy you gotta be a professional when you buy at an auction. You gotta know what you're doing, because a lot of those cars, they're gonna need fixing. So if you're gonna spend $2,000, expect to fix it up at an auction.
I was gonna say that if you, look, I'm all for
getting it for cheap. Correct.
No, buying something you build equity on, a depreciating asset, right? Like, you get a depreciating asset like a vehicle, and you're able to buy it under value, and then actually figure out a way to insert equity into it. I think that's special, right? Because you're kind of bucking the trend. But the reality is that when you're buying it, I mean, unless you got somebody in the family that knows about cars and the extent of what your downside could be, you could put yourself in a worse situation. So sometimes that's a little tougher. But maybe she has somebody in the family that's able to do that, or maybe that's possible. If it is, then absolutely, that sounds like a great idea. If not, then it may be tough to handicap and potentially discount and put you in a tough situation.
Yeah, I don't know if you've been in contact with our customer Freddie in California. Freddie had an interesting conversation with him on Sunday. He wanted to pay off a collection that posted on the credit report. I believe he sent you an email about it.
Yeah, he did. Yeah, he sent it.
Okay, so it's a Capital One. What was it? Was it a Capital One card?
It was a Kohl's charge-off.
It was a Kohl's charge-off, and then it got bought by a collection company. He was thinking, okay, the collection company hasn't posted it as a collection on the credit report. Should I pay it off? Yes or no? You had that conversation with him. Can you go through that a little bit? Because I told him to, request a phone call if he doesn't understand.
Yeah, they asked if he should pay it, and I said, listen, we don't, and this is how we always say it. We don't tell people not to pay their bills. Obviously, if it's something that they want to pay, by all means. If you pay it before it reports, then it's not going to report. That's just the way it is. He's on top of it. He got his hands on it early. Meaning, like, the minute they sent it, he got it and was responding quick enough. Now, for people that don't have the money, like, Freddie and his mom are buying a house, so they're trying to move this as quick as possible. I told him that our standard course of action is typically in situations where collections haven't reported yet, and they do get out in front, and they're assertive like Freddie is. We'll send a validation out, in which in a lot of cases, if the debt's just been received, like it is in this case, they're not going to have the documentation they need. So more than likely, it's not going. They're going to have to remove the account anyway, and they're going to have to send it back to the original creditor, which in this case is closed.
Yep.
But he wanted to just make sure it wasn't going to be extra bleeding in the event that for some reason, some way, albeit a very small percentage, they would have a copy of that and everything else we need to validate it. Then he paid it and he settled it. I don't know. He at that point, you don't need to do a pay to remove because it hasn't reported yet, right? You're getting it before it reports, so they don't report just in advance. So they typically, if you get it out in front of it, they're not going to report because that's their leverage against it. So that's kind of how that played out with him, and the conversation, the thought process that goes along with it. But again, reselling is a very small, like in our situation, I would say, we tell people an actual debt getting resold, especially in a situation like this, it's not that common. When we work on it, like if it gets resold before us, that's fine. But after we start working on it, it's rare you don't see a ton of resales.
Correct.
Now, Freddie, I think we're in the second round right now with Freddie, so we really just got started on it. So it's not really something that we've been working on for that long. But we're middle of the second round right now as we speak. So it's good that he got out in front. They got their eye on the prize of getting this house, and it's one of those situations where they're just wanting to get in. So as a result, we're trying to move it along as fast as possibly can. And when things like this come up, this was the fastest way. But there's sometimes the clients aren't able to pay. They don't have the money, and it's not. In this case, it was like $500, but some cases it could be thousands, and the client doesn't have it. In those instances, we'll turn around and we'll send the validation after we get it early on. And like I explained before, a lot of times when these debts come over to the collection companies, they come over in tranches of 15, 20, 30, 40, 50,000, right?
Yeah.
So when they get them at the collection companies, they pump it right into the auto dialer right away. Now, they may not have the rest of the paperwork on that account immediately. That stuff comes over in bulk. Imagine getting 100,000 people worth of validations and agreements and contracts. That doesn't come over with the file initially. Trust me, the file comes over. I've seen these bundles that come over in Excel spreadsheets with literally with all the contact information for the individual portioned off. So they pump that right into the auto dialer and start working. They don't
just like a list pendants.
A list pendants?
Yes.
I don't know what you mean by that. But as far as I know what a list pendants is. I don't know what you mean in regards to the.
Well, like when houses, they're late for the first 3 months in New Jersey. They go on the list pendants. The list pendants is like a spreadsheet where it's for New Jersey. I'm pretty sure they have it for each state, and it tells you all the.
There's list pendants in each state, but what I'm saying is that this comes as like a. I want to say it's like a zip drive. That sounds very basic, but it's not like
okay.
that. But don't immediately start dipping in and start collecting on it. That's why if you get it early enough to send a validation, your validation actually holds weight.
I get
it's
you.
not something you got online, on a credit board. More than likely, if you know what to ask for and within that particular state, because each state's a little different, as well as everything else, normally they don't have it that early because they start collecting immediately. Most people don't know to ask for validation. So if you're working from 100% capacity as far as like all the files you get over, and 5% know to ask for validation and what to ask for within the validation, then you're still collecting 95%. You don't have to worry about it, right? But for the people that do ask for the 5%, they'll turn around and send it back to the original creditor. They'll say, forget it, we can't collect it now because we didn't have what we needed. And they can't turn around, if they can't produce it within 30 days, they can't collect on it at that point, right? Because they're not following procedures, so they send it back. And then it'll sit. And then you'll see the original creditor not resell it again, right? So because they'll know that's going to happen each and every time. You understand what I mean? They're aware of the fact that each and every time when they're selling these debts, they're not going to sell it individually. In this case, they're not going to sell a $1,500 Kohl's debt individually. Who's going to buy that?
I get you.
So it ends up being a situation where after you get it once, you don't see it again. It ends up that's the end of the conversation, and it'll sit with the original creditor. They'll typically hold on to it in perpetuity unless they take it to court, which again they would have done before they resold it. So that the likelihood of that is almost zero. So it'll just sit until it gets removed, and then it'll sit until it ages off in most cases.
Well, the Glenn Bias just said, that's how I feel with portfolio. Stubborn collector debating whether to pay to remove or just wait till I get dispute it eventually?
Yeah, I mean, I think, look, portfolio is, I mean, two of the biggest, portfolio is a publicly traded company, by the way. I mean, a lot of these collection companies some of them are enormous, right? I mean, they're very well funded, they're very well capitalized. So, I mean, portfolio is one of them. They're a very big operation, and, you know, going in and doing pay to delete, so that's not always a given with them. They don't have to do that, right? Some of the collection companies that'll do that for you are normally smaller ones that, you know, or if it's an old debt that's about to age off, right? And they know they don't have the leverage in the conversation. Outside of that, especially if you're somebody that they know that they have assets identified in regards to you, I mean, they're just licking their chops at that point. They have no motivation to want to do a pay to remove. And I think a lot of people are misled that they think that these collection companies just automatically do pay to removes, right? Yes. I think they think because they've heard, you know, it's like the Goodwill stuff, which we heard. Yes. And now all of a sudden it's just vanished, right? You know, they were the biggest thing since sliced bread from January until March, and now they've just vanished. You know, then it was the credit bureaus are closed, that vanished. Then Correct. It was, I mean, it's
freezing LexisNexis and all this other stuff.
Yeah, and now again, I can't help but continue to comment on the fact that there was another 2 clients this week whose files were split. So, I mean, these are new clients. These are people that did it that way previously, like I described last week. And we're continuing having to merge these each and every week. And I cannot help, and I'm going to find the true tie that puts it all together. But I cannot help but think that a lot of this is being caused by the fact that these things are being frozen in conjunction with the other way I talked about. But I'll be able to figure it out over the course of time. But in the last 4 weeks, I think there's been 6 or 8 of these that I've had to merge. And when they call up, they have to get them merged. I mean, this is not just me speculating. It's that they call up the bureau, and the bureau's like, yeah, we see it, we'll merge it. You got to send over this, and this, and then we'll take care of it. And they do it.
Miss Divine is asking, what does the split file look like?
So here's a good way to understand how you can arrive at a split file, right? If you let's just say you go on your myequifax.com, which is the free dispute portal. It's also the free site that Equifax set up after the breach, right? Go on there, see copy your report. If your report, the meat of your report, okay, the inquiries, all of them, the accounts, in its entirety, right? Total amount, how many installment, every single thing needs to be identifiable. If you go on another site with the same date, okay, so let's just say you go over to Experian.com and you update your Equifax bureau. And you compare your report from MyEquifax to the Equifax report on Experian.com that you just updated. There should be no deviation. They should be identical files, okay? Then if you go over to Identity IQ, same day, update Identity IQ, right? And when you update Identity IQ, you look at your Equifax bureau, same day, all things the same person. Identity IQ's Equifax should look exactly the same as Experian and MyEquifax. They should all look the same. There shouldn't be any deviation. All the names should be the same, aliases, employers, etc. If you go to, let's just say for argument's sake, let's work down the line, you go to ScoreSense, and ScoreSense pulls a report on your Equifax, and it's different, right? It might be subtly different. It might be exponentially different. In a lot of cases, it's fairly exponentially different, where you'll see, you know, a different name deviation as the primary. There may be a different address or a couple different addresses, and the report's entirely different. Entirely different. Not like made up stuff, but for instance, much less. Like, for instance, or more. Like, we've cleaned a couple clients' Equifax files that have been completely done. Then we've seen situations where we've seen deviations. Like, there's a client of ours, he's been a client of ours before, he's a client of ours again. This was just over the weekend. You know, he updated his report, and he's like, I see these school loans that are showing on my Experian. He updated his Experian as my FICO, and then we had his we updated his Experian as my FICO, and then we had his my Equifax comparing this. His my FICO had a certain file of report on his Equifax. His my Equifax deviated ever so slightly. Now they were all in the 7s, right? They're all like 715, but he was showing these school loans on his my FICO. It was all good paid history, but his my Equifax didn't have anything, right? Didn't have anything under all those paid off accounts. Those positive accounts weren't even there. So the point I'm trying to make is, in a lot of cases, like, you know, in this file, this particular client I'm referencing now, he'd gone down that route in the past, and almost all of them, they're all identical. They're all identical, right? I mean, it was done the exact same way for all 6 or 8 of them, and these are all relatively new that we've taken on. So to answer our question, if you're seeing any bureau deviate among sites, assuming it's the same date, right? Obviously, if there's a date deviation, something could have happened in between that date deviation. But if you update them all on the same day, and all the different sites and or hard pull should all be showing the same thing per bureau, right? There should never be a difference, ever. It doesn't matter what site you pull it from, whether it's Credit Karma or whatever, there shouldn't be a deviation. If there is a deviation, that means there's multiple reports with that name. And certain things, typically speak, how the name was input or the address or something associated with that is what's causing the second report to be pulled, right? The split file. The problem is that, let's just say that split file only presents itself 25% of the time. That could be 25% of the time it causes you a problem, right? Why would you want to have to hold your breath every time you apply for credit with an Equifax or an Experian or a TransUnion lender if you don't have to, if it can be fixed, right? As a result of maybe making a mistake or a misstep before. This is why we always say, and I stress this so much, is that it's very, very important to really do your diligence on who you work with on the credit stuff, because I don't think half the people know the damage that they're doing when they're doing it, and they don't do it intentionally, but they have no idea the fallout that comes from this stuff. And since most people go through a long process before they decide to spend to work with us, but we're typically the ones that see them through and are holding the bag all the way through, so we got to clean up everything that has transpired before, that we now have to get them in a position not only where they can finance, but where they don't have to worry about issues coming on going forward. I implore people to do your research in what you're doing. Don't let it always be the cheapest solution, right?
Correct. I mean, but the split file happens when you do a CPN, when you change your name.
No, so I mean, look, typically speaking, it's done as a when you file and now this has been going on forever, and we've talked about this before, but when people file fake police reports and couple it with a fraud affidavit, they submit it to the bureaus. Back in the day, 10 years ago or so, that the bureaus weren't equipped for that. So that would always work, right? Yes. Like a 99% scenario where you did that and it would work. Now they have fraud teams, and we talked about this before, they beef them up and all them go through that, right? But what they typically do is, as a preventative measure in situations like that, is they'll add a second file, okay? And they'll do that out of your protection, because the idea is that the first one's been compromised, right?
Correct.
So once they determine that that's not a fraudulent account, that second file lingers out there. You understand what I mean? So it just lingers out there. So it still exists. They set up the file, everything gets set up, that second report gets set up, but it lingers because it wasn't ever finalized because of the fact that the fraud was determined to be fake.
Wow.
Meaning that they weren't really victims of identity theft like they claimed. The bureaus made this. That's why you're seeing this more now than you can see it before. Does that make sense?
Yes.
So that second file just lingers out there. That second file that was whatever that they tried to portion over, good, bad, or indifferent, or were setting up throughout the whole process of setting up that dispute, it's just lingering out there in their system. The problem with that is that it'll continue to linger out there, and it'll continue to follow them around and present itself. It's like a pimple that just won't go away, right? And it pops up whenever you don't want it to. It's exactly what these situations are, and that's exactly what ends up ultimately happening. So the only way you can fix it by calling up, telling them you want to merge it. Takes them a couple days to merge it. Once they get the paperwork, they'll merge it, and then you're good from that point forward. Most people don't know to identify it, though. There's people that don't understand the sheer fact of that literally every report should look the same. You understand what I mean? Not bureau dependent, but not like all three bureaus shouldn't look the same.
Correct.
Right, if you're working on it. But like Equifax should look the same on every report that same day that you're looking at among any site or a hard pull. There shouldn't ever be a deviation. It should all be the same, because that's coming from the same bureau, with the same person, with the same social. It doesn't matter what medium you're utilizing to pull it, it should always look the same if it's on the same day, right? Or in the same period when nothing else has changed. People don't even understand that. So when they see a difference, they don't know what they're looking at. It takes somebody like me to be like, or not only me. I mean, there's a lot of smart people out there that understand what's going on, but or more astute in this side of things. But like for people that don't recognize it, it's important to recognize it, because it will continue to present itself as a problem going forward. So it's been a headache. I anticipate seeing it more. But I mean, it is what it is. This is what ends up happening, when I'm trying to say this diplomatically, when there's corners that are cut in some cases, and certain things that are done that are meant to be beneficial, but in essence they're not. And I think the other problem that's coming into play is that when you merge it with this is what I had said last week, and I'm not 100% sure of this, but I'm sure I will be over the course of the next couple of months as I continue to do this with clients.
Okay.
When you take the high-level fraud scenario and then you couple it with them freezing, because most of them do that, right? That's the recipe. They'll go and they'll file a fake police report, they'll send their fraud affidavit, and then they'll freeze LexisNexis, whatever the other one is, and the other one is, and that's the magic trick, right? Boom,
yes.
there it is, done deal, right? Problem is that the person on the receiving end wakes up 2 disputes later and realizes nothing was removed, and all they got is frozen public record site and a credit report that looks exactly the same as it did before, right? So they don't know the fallout. Most of them leave it on there because they watched some YouTube video that told them that you shouldn't have that. There's public record site reporting, right? So they don't know what actually ended up happening. And I think I think the fallout is still coming from that. And I think there's going to be more fallout that comes as a result of that, right? And I can't help but think the exacerbation of these split files, because I've been doing this forever, right? And I've worked on so many files, and I've seen so many where people filed fake police reports where it didn't work out in the past. But just now, in the last 6-9 months, I've seen more split files than I've seen the previous 9 years. And I can't help but think that has a very large probability to do with these people freezing as well, right?
Yeah.
Freezing these public record sources. And as a result of that, it's exacerbating the issue, which is causing the problem. So, I have not connected all the dots from A to Z, but there's far too many coincidences coupled with the fact that this is kind of the fad of the week, right? It's the latest fad for the last, year and a half or so, and you're starting to see more and more people do it now. People that have no idea even what they're doing it for. They're just doing it because they watch YouTube videos and you should do it. So coupled with that level of recklessness, I can't help but think there's probably a very significant tie that binds it. But I'm sure I'm right on, and I'll be able to identify later as I continue to work through more and more of these. Like I said, I'm averaging 2 to 3 a week at this point.
Oh man, is that extra work for you, Jay?
No, the clients have to call. So the clients are calling themselves and having to merge it. They know that it's they know it's I couldn't call for them anyway.
So Jay, you could merge your bad stuff into your file.
Unfortunately, you have to do that. In a lot of cases, this is situations where clients, we've cleaned up their file, and now they have to merge all this other shit now. So then we got to go back and do more work on our end, which is fine, because we know that at least this time when we send them off, they're going to be done, right? But it ends up being a situation where you may be incorporating accounts that were quote unquote told that they were removed, that they weren't, right? And now they're being merged, and now we got to remove them as well after we already cleaned off the other ones that were on the existing file. So look, it is what it is. It's part of the business. There's things like this that we got to work around, and everybody thinks it's a snap your finger type of thing, and unfortunately it's not. And in situations like this, it's even more not. But it's part of the business, so it is what it is, I guess.
Okay, I have Marcus Franco, who asks, do you guys feel getting a rehab home on raw land for 1/4 of the price of a home still good idea if you had a great rate versus buying home?
Okay, so it's a little confusing. You're buying a rehab home on raw land? How can it be?
Yeah, do you guys feel that getting prefab
building a prefab
on raw land for 1/4 of the price of a home still a good idea if you have a good rate versus buying a home?
Right, but it wouldn't be 1/4 of the price. When you scale it out between the cost of the land, depending on whether the land's entitled, if it has utilities running to it and everything like that. I don't know how rural you are or how rural the property's going to be. Most places have, utilities run to it, some don't. And if you see land that's extraordinarily cheap, in a lot of cases, they may not have anything run to it. So that means you got to literally run all the water to the street, then into the house, and whatever else, the gas or whatever kind of energy source you're going to be utilizing in that particular house, and then you got to entitle it, before you can start building out. You got permits, plans, etc. That's why you'll see land come a little cheaper sometimes, depending on how rural the area is. Then the build is normally, even if you prefab it, you're talking probably. I know it's gotten better over the years, and I know it's kind of the preferred scenario, especially if you're getting a much more traditional house. But I still think prefabs come finished at like $100. I want to say like $120 a square, something like that. So I don't know how it would break down to 1/4 of the cost. But I think the other problem you run into is with mortgage requirements tightening so exponentially as they have. Not so much on the scores or anything. Not so much on the FHA stuff like we talked about before. but more so on the actual like underwriting of it, right? They're they're trying to do everything they can to slow these mortgages down, to rake them over the coals, doing everything they can to try and drag it out the best they can in an effort to make sure that if they are taking on the loan, it's going to be the one that they want, and it's not going to come back to haunt them. So I think with that, obviously new construction, which is land to perm, it's, they're higher risk for obvious reasons, right?
Yeah.
And as a result, they're not typically in environments like this, they're not really high supply. But I mean, I guess it would really break down to the numbers of the situation, and if it was a situation where the numbers worked exponentially, then absolutely, man. I mean, why not? If you can find a situation where you can get something brand new, have it built brand new, and you can still be under market significantly and be under whatever the potential downturn could expose you to, for sure. But I just think all those variables combined, I think it's going to be tough. But if you found a gem, there's gems in every market. So if you found a gem where you can mitigate your risk early on and discount it early on, so that even if it does pull back, you're still in a really comfortable position, and you've measured your downside like that, then why not? I mean, this way you get to do it now rather than wait, right? But obviously the things that lose their most value in markets like this is land, right? Even if it's entitled, because your buyer base gets tighter, and especially if it's not titled, it doesn't have permits or plans or anything like that, it becomes worthless. So it starts to really, it's not worthless, it still holds value, but it just, whatever premium was sitting on it, really starts to subside greatly because your base of buyers cuts back exponentially. So I hope I answered it. I went a couple different directions though.
Yeah, we hope we answered it, Marcus. But these houses, when you build them, they don't do any more tanks under the house, right?
What do you mean? No. You're talking about I forget the term. What is it called?
Oil tanks?
No, they definitely do. They don't do oil tanks, but that's what you're talking about. They're talking about like the sewage tanks. What are they called? But no, they don't. I mean, I think you can, but that wouldn't be the solution. Right?
Okay.
I mean, that only works in certain situations, and you can't bank on that. And if you have to run a water line, right? If you have no water coming up to the property, you might as well just run gas because they're going to run next to each other, right? It wouldn't make any sense.
Skeptic tank.
Septic, there you go. That's
skeptic tank.
Yeah,
right.
I mean, I don't think anybody chooses to use septic, right? Like that's like something you get stuck with, right?
Yeah.
So I mean, it's not. I mean, but look, he would hopefully give enough information to make the right decision. Or
before we leave off the topic of the split file, Miss Divine heard someone say split files result from doing too many soft pull inquiries from bumping them off.
No, I mean, I'm not saying that doesn't, like, as far as like, there's not a repercussion out of doing too many bump offs or whatever that is, but that one would have nothing to do with the other, right?
Correct.
It wouldn't cause you to have another file that's totally different from the other file, right? It's just so unique that every single one of the split files I have was disputed previously the exact same way, in the exact same manner, in the exact same fashion. So I'm not saying what she's saying is incorrect. I'm just saying it's far too much of a coincidence that in the last month and a half, I've gotten 6 to 8 of these, and they were all disputed before they came to us the exact same way. And I'm now having to do this after we cleaned off, certain bureaus, and we went to run it, and we're seeing deviation. And you should be able to see, it doesn't matter if there's a soft pull or not. I mean, a soft pull goes against the broader file. So you see every one of the soft pulls that gets pulled. I mean, it wouldn't, I mean, I understand maybe the philosophy is that it only registers a certain amount of soft pulls. I don't know. I can't really make sense of that and tie that together, but I personally have seen the situations where we've had to put them back together. So I'm having to do them almost weekly now.
Okay. Marcus said, thank you, John. Hit the nail on the head.
Okay, good.
So let me see what else. Alan Styron. So what's up, Styron? Just became a customer this past week. He said good information. Let me see what else. You guys, Coles. Okay, yeah, that's about it. Murphy, Ashley, everybody watching, thank you so much. Skeptic Frank.
I think the one thing to I know we wanted to make this case more about the interest rate situation. So I think the one thing that I really want to impress is that, not that this is going to be a problem, but I think that as interest rates tick up or tick down, obviously assuming your revenue, your income stays the same, that's going to directly impact the amount that you can borrow. And I kind of want to get into this. Just I know I touched on it really briefly before.
Okay.
But I want to get into this in a little more depth.
Okay.
So if you're somebody that's buying, let's just again use $100,000 house. Let's say you're buying $100,000 house and rates were previously at 3%. Your payment would be $300. So for instance, let's say you made $600 a month gross, and your mortgage payment now is $300. Right, that would leave you at 50% debt to income, assuming you had no other debts, right? So that would leave you levered at 50%. Same person. Okay, let's say rates went up to 5%. Okay, 5% on $100,000 would put you at a $500 payment with no other debts and $600 in income. You would be in that situation at 80% debt to income, right? So in order to get it down, you couldn't afford as much, right? So it would knock you down in the amount you can afford. That's how interest rates swing. Obviously your affordability, but also on a broad scale, it swings the values of properties, because most people that are coming in and buying houses lever up to their heels, right?
Correct.
It's very rare that you see people come in and they'll do they'll be sitting at a 35 or a 40% debt to income ratio. You just don't see that. Most people go right up to the very last percentage point, up to which, as of February, was like 55% roughly on average. And they'll lever all the way up. So if you make $1,000 a month gross, you could theoretically borrow, including your bills, up to $550 a month, right? And that's what people will do. The problem is when that rate ticks up a little bit, then they can't afford as much, right? Or if that rate goes down a little bit, they can afford a little bit more. It's all exponential, right? So as you see that, then you can start to make that determination, all things the same, where those rates going down or going up are going to help you as far as your borrowing capacity if you're in the market to buy, right? Because they're going to you're going to reach out to your lender, and they're going to just do the math I'm doing right now. That's just the way they're going to look at it, and they're going to arrive at it. You can do the math yourself. You don't need them to tell you how to do that, right? And it's not like it's not rocket science to do the math, in making that determination. So you take your gross income in this situation is 1,000, right? And again, this number deviates a little bit, but let's just say for argument's sake, it's 55% debt to income. So $1,000 in gross income, because they always use the gross. They don't use the take home. They use the gross.
Okay.
And they take 55%, which is $550. From that $550, back out any debts on your credit report. So that would be school loans, payments, auto loan payments, minimum credit card payments.
Yep.
Any personal loan payments, or in situations where you have none, then you have nothing to back out. And then in my scenario I just painted, it would leave you $550 available for whatever mortgage principal and interest payment you had. In that case, that would afford you at 3.5%. That's an average rate right now of approximately what's that? What would that leave you at? $150,000, something like that.
Mm-hmm.
Right, to purchase, which sounds a lot larger than I thought it would be at $500. But whatever the case, that's how you'd be able to understand how you steer it and be able to back into it based on these rates going up and going down, and how you can kind of control it, right? Yeah, I mean, you can't technically control it, but you can control the understanding of it. And so somebody can't really try and manipulate you by rushing you into locking in, or locking you into a rate that you aren't necessarily comfortable with, or any number of variables maybe you're not 100% comfortable with. In a situation financially where you're walking into stuff you're uncomfortable with. I mean, educate yourself. Make sure you understand what you're doing before you do it, right?
That's true.
Otherwise, don't do it.
Correct. Miss Divine just said, you hear about Kickoff, ? And it said, Kickoff is the competitor to Self-Lender. They give you 12 and you pay back one a month for 12 months, and they report to bureaus. Seems too good to be true.
I'm not familiar.
I'm not familiar with the Kickoff.
Fan of the Self-Lender stuff, or the
yeah.
just because don't see it. I think people are under the interpretation that, age and dearth. If you're a thin file, I think the self-lender can help, like a really, really thin file.
Correct.
And maybe what Divine's talking about can help, but I think generally speaking, if you have a reasonable size file, I see them provide absolutely no assistance whatsoever to the file. But I haven't heard of that. I haven't heard of that program because I'm not really looking in a lot of cases for those situations unless it's a file that needs to be built up a little bit. And in situations like that, then we normally will walk them down some unsecured ways that they can start to build it up before we get into the self-lending kind of stuff. But I'm sure it helps some people, but we're just not huge on it.
Okay, I got Ernest Dobson. How many trade lines are needed to get credit cards if you have nothing on your file?
Well, I'm familiar with Ernest's file.
Okay.
And we're basically done Ernest's file for the exception of one little thing on one.
Okay.
And in his case, because he has a thin file,
okay.
We'd have to. I think he and I discussed this on the intake call, but we'd have to kind of guide him in a way as far as building up, getting some primaries, and then he can add an AU or two just to give it some weight, to give it some, to give it some depth as far as the age, to give it a high watermark as far as the high side, and then, that'll give him something that he can start to grow on. But he's still going to have to build out a primary base as well in order to be able to really substantiate it. So, Ernest, when we get this last account off this one last bureau, we can jump back on a call. We can go into it, because it's not a simple answer. It's going to be something we're going to have to structure a little bit. But as far as the total amount of AUs, I wouldn't think more than one or two, honestly. I'm not a big fan of just inundating a report with AUs.
Correct.
I don't. It's a lot of money, and unless you have somebody to add you, and there's a certain point in time with them, they stop losing their value for the purposes of the unsecured credit ratio element of it. There is age that comes with them that's helpful. There is depth that comes with them that's helpful, but that tops out at a certain number, and so does the unsecured credit ratio. The ratio is already down, so you need to add 100 of them. Probably adding 10 of them probably gives you the same effect as adding one in some cases. I don't know how the broader file looks. So we'll talk about it though as we get this last account.
Correct. I have Freddie who also asks, hey, John, thanks for the advice today on my mom's collection account. One last thing, John. Does it improve the chances of removal of the closed Capital One account since they sold debt to third party?
Nothing to do with it.
Nothing to do with it. It still needs to be disputed.
Oh, without a doubt, for sure. But I mean, it doesn't ease or alleviate. People constantly, and Freddie's not alone with this interpretation, but the interpretation with some people is that, a paid debt is easier to remove than an unpaid debt.
Correct.
An open debt, a closed debt is easier to remove than an open debt. It's the same process. It's not any different. They're still reporting. They're still responding. There's not a different department that handles a closed account and the reporting of that closed account. There's not a different department that handles an account with a balance versus one that doesn't have a balance. It's all going to the same dispute department that handles the response to these disputes. And it doesn't go to an area that has a lighter load of people just because it's closed, unfortunately. So no, it's not gonna deviate or change that. It's not gonna really have any impact on it whatsoever, other than just the psychological aspect of the fact that the bleeding is going to stop as far as being resold, and you don't have to worry about the amount outstanding. But it's much more of a psychological victory than anything. Okay, Freddie. I hope we answered that question. Now, Styron asked a question: Can I have trade lines added to my report to decrease my utilization under or at 30%? Without a doubt, we do that a lot, especially in situations where clients need to make up points in a short period of time, or if they're trying to get unsecured credit. It's a great way they don't have the money, right? Like, for instance, just for scenario purposes for people listening, if let's just say somebody has $10,000 in cumulative credit and they're at $9,000 in balance, right? At that point, they're effectively maxed out, and they're losing probably 35, 40 points, roughly, give or take, beside the depth of the file. If you turn around and add a $25,000 AU in that case, cumulative limits are now $35,000. your balance is still $9,000, assuming that AU didn't have any balance on it, right? So now you just went from running at a 90% scenario to running at about a 28% scenario, roughly, right? And in that case, you're going to make back probably 30 points on, in that situation. So it'll jump you up immediately because you're feathering out the unsecured credit ratio. And in that particular case, it'll jump the score. So yeah, to answer the question for sure, yeah, that's one of the main reasons, honestly, nowadays we try to, obviously the AUs help to raise the high water mark in some cases, but it's also very helpful in lowering the unsecured credit ratio, which ultimately jumps the scores too. So it's just another way of bolstering scores. But yeah, definitely you can.
So,
not right now for his file, but definitely when the time is right.
When the time is right. So even if he was to add another what you said, another 10,000.
Well, he doesn't. That scenario I gave wasn't his scenario.
No, I'm just saying in that scenario that you had, that you said that you added another one.
In that scenario that I had, if you added another 10,000, you could go from 90% usage to roughly 50% usage, 48% usage, which would still jump the score probably 20 points, right? You still get a jump in the score, but it would make the most sense if you're going to add an AU in that situation to feather all the way down under 30 and get as much of a score increase for the money that you're spending, right? So you would want to get it higher, get it up around 25, which would jump it from 10%, $10,000 limit up to a $35,000 total limit with a $9,000 balance, which, like I said, brings you down to around 28%, which would jump the score about approximately 30 points.
But won't that add more debt onto his credit report as an author?
Because there's not going to be any outstanding amount on the new AU. So there's no balance on the AU. So there's no debt to reconcile.
So when the algorithm goes and checks the report, when they go for funding, they're going to take in consideration that AU, that it's $10,000, let's say, or...
Well, 20 in the scenario I just gave was 25,000. He had 10 existing on his own and just added 25,000. And typically speaking, the way the algorithm's rated is they'll use it as a high watermark based on what he, what it appeared he managed over the course of time, right? Because some of these cards are older. You had an AU, might have 6, 7, 8, 9 years on it, and it might reflect. And look, some of the card companies have changed where they, AUs aren't even acknowledged by them anymore. But a good amount of them haven't. Right? A good amount of them have been. And mortgage lenders, every FICO that they use, all of them get acknowledged and noticed. So for the sake of funding, though, some of them have effectively made AUs visible. They switch the algorithms out to where they're not even recognized. But I'd say it's a smaller percentage than the other side of it, meaning like the companies that do still recognize them and notice them. So, it's not going to factor into your debt load though, because there's no balance on that other card. So it doesn't matter.
Okay, great. That's a great Styron. When you're ready for those trade lines, we'll definitely let you know. Marcus also had a question. Does staying under 7% debt to income rather than 30% increase score or grow line of credit faster, or is that just a myth?
I think he's confusing two things though. Debt to income is the ratio used in approving applications for how much you can totally be approved for. You're talking more on the unsecured credit ratio, which is effectively your cumulative credit card limits against your cumulative credit card balances, right? And that's what he's talking about. So I believe he's saying is 30% or 7% better. I haven't ever look. I don't know where you got the 7 specifically from. Obviously, the closer you get to 0, the more of those 35 or 40 points you're going to capture, right? The closer you get to 99.5% on usage, the more of those 35 or 40 points you're going to give up, right? Anything in the middle is just that. It's in the middle. Obviously, the lower the usage that you have, with still some activity on the cards, obviously, it's a situation that you're going to show that you can balance it, and you're going to look like you're capable of balancing it. If there's anybody that can talk intelligently about this, it's Divine. I got to see Divine's file today, and her $500,000.
Oh yeah, what's up with that?
No, I mean she's exactly what she said, and I mean it's over a number of cards, but it's still very well organized, orchestrated, put together. I mean, it's an accomplishment what she's put together in doing things very, very pragmatically, right? But disciplined and keeping it together. I'm not sure the average human being is capable of doing that, especially a lot of the clients that are just trying to get their financial footing together. But I think it's impressive what she was able to put together. I haven't ever seen her file like that.
Oh, wow.
As far as like that amount of credit raised over that many different cards and without having really any issues. So she does a good job of knowing all of it and putting it together. But to answer Marcus's question, I would just keep it keep it as low as you can, right? I mean,
Correct.
I mean, when you're borrowing from a credit card anyway, it's a very high interest over a short amortization. So it shouldn't be an idea unless you're rolling over and playing the Monopoly game where you're borrowing them, rolling it over to zero balance transfers, etc. It's a situation where you shouldn't be carrying many balances on there unless you have to anyway. But if you have to, just know that the objective will be to try and keep it as low as you can. If for some reason you got to run it up and you lose the points as a result of that, do your best to try and pay it down, and you'll know how to recoup those points, right? Once the file's clean, there's only a very few things that can really swing the file in any number of directions. One of those main contributors is obviously the unsecured credit ratio. So once your file's clean, Marcus, and you're in that situation, you'll know just exactly how to swing it and what capacity to swing it by. Keeping the ratios lower, if you do run them up, knowing how to run it back down.
Glenn Bias just said, pay off total amount every month will help build credit regardless if you transfer a balance for the next month or not.
I mean, it's not going to, here's the thing, you're going to build credit with the creditor, right? But the reality of the situation is, as far as reporting, the creditors report every month the day after the statement date. So if you don't have a balance to report, it's going to report zero every month. So let's just say your statement every month. Now, what Glenn's saying is true is the fact that with the creditor, if you run up, let's just say it's a $5,000 card, you run up a couple grand each month, you pay it off on the statement date. That's great. It shows to them you're managing credit, and they're the kind of accounts you're going to see them want to extend you more credit on those line increases without you even asking for it. As far as the bureaus are concerned and the scoring element of it is concerned, that's a totally different thing, because in essence, what's happening is that if you're paying it before on the statement date, on the due date, paying it off entirely, the next day or 48 hours later is when it reports to the bureaus, and there's not going to be no balance month after month. So you're not going to see the run up or run down. It should be zero, which is fine. There's nothing wrong with that. It's going to keep the score propped up. It's not the end of the world. You're getting the points with the creditor because you are using it, and you're getting whatever rewards associated with it, and you're paying it off. So you're showing that you're handling it properly, how they want to see you do it. It's just there's not going to be any more of a scoring component outside of just the ratio itself, showing it zero and keeping your ratio all the way down, which will keep it propped up for that 35, 40 points we talked about.
Correct. Yeah, that's good. That's good information. Wow, Ms. Divine Brown, she got that 500,000 in personal credit. Jeez, I don't know. Well, she says she helps people increase their credit scores, I guess.
What's that?
She said before she got on us, she helps people increase their credit scores, and how she was able to get herself, $500,000.
Yeah, I mean listen. I think
I don't recommend having all that debt.
A tremendous amount of discipline, and like I said, she's very pragmatic with how she handles it, which is a good thing. He's very discerning and very like on top of it and everything like that. I think that and very calculated in how everything's being put together and paid off. If she has a routine, she put it in the email. I don't know how scalable that is for other people. I'm sure she's not worried about that. It would be very difficult to get the average individual $500,000 in unsecured credit and tell them to manage it wisely the way she has, 50% that she has. But I think the fact that she's been able to do it is a feat in and to itself. And I think the thing that's even more surprising me outside of the $500,000 is the fact that they haven't closed any of these, which means she's using the right amount of usage on each one of these over a period of time that's not, basically effectively not triggering them to be like, listen, you're not using these, use them now or we're going to close them. So she understands that, which is a niche into a niche into a niche. I mean, it's impressive.
Here's the thing, Jay. I heard on Facebook, a couple of people posted, my wife didn't use my credit card, the credit card for 6 months. The creditor closed the account, and when she called, they said, "Oh, we thought you died of coronavirus."
That sounds ridiculous.
That sounds crazy.
Stop it.
Well, that's what they said. But then another person said, listen, I didn't use my credit card for 6 months and they closed my account because
No, 6 months is not a real thing, man. That's not a real number. It's not six, unless they're desperately trying to get rid of that person. Right? 6 months is not a real thing. Maybe a year. It may be a year, but 6 months seems really tight to want to shut down an account. Now, maybe they don't want that person as a client. I have absolutely no idea. But 6 months sounds tight, and making the assumption that somebody passed away from coronavirus.
I never heard that before.
That sounds like a story that came from Facebook, though, right?
It was a Facebook story.
All of that sounds like a Facebook story. That sounds like a story that's fraught with question marks, right? And just maybe a lot of confusion. So, normally, though, that's why I just said, though, in regards to Divine, that it's impressive the amount of cards that she has that comprise that larger sum, that she's been wise enough, or, like I said, pragmatic enough to be able to know how much to use with each one, so she doesn't run into those problems, and she continues to keep the creditors happy without any issues. I think, like I said, there's a lot going on there that she manages. That I think manage is a very operable word to keep all that together, which I think is awesome. I just said that, but I think it would be very difficult to replicate in a consumer, like just your typical person, right? I think it would be so overwhelming for somebody to have the level of discipline that she has in regards to it. But I think it's an accomplishment, nonetheless.
Yeah, Glenn just said.
I'm over 10,000 clients in this business, doing this over 10 years. First time I've ever seen that amount, that size, and that amount, based on the income that she told me she states.
Yeah.
I don't even know how they arrive at that. I can't even make sense out of it. So whatever the case, though, it's
that's what I was gonna ask you. Don't you gotta be making double that or triple that if you show?
I have no clue.
Okay.
Look, 99.999% of the time I have the answer, and it's that 0.1% where it's the only time I've ever seen it, and obviously she understands every element of putting this stuff together and how she's able to put it together, so it's to her credit. I can't make sense out of it from a number of different ways, but it's obviously real. So, it's like I said, it's an accomplishment in and to itself.
Styron says 500,000. Wow. What I've learned about credit, I think it should be used to invest and not try to live off it. Investments that bring back a good return is a good reason. It's a good reason to use credit to invest. I think it is why a lot of people get bound in debt. Yeah, it's true.
I don't know if it's number one. That's not what Divine used. Divine just had. She doesn't. She's not living off of it. Just to clarify, there's very little usage on these cards whatsoever. So, broadly speaking, though, these are all credit cards, right?
So John, even now with Divine's situation, can she get into real estate and get properties with her credit cards?
Well, that's what I was going to say. That's what I was going to tie it up to. I was going to say that, obviously that's short-term money and there's certain caps on that. That 500 is made up of a number of cards, right? It's not just made up of 5 cards. It's made up of a number of cards.
Correct.
And I hope she doesn't mind us telling this, all these different aspects. I'm not going to go into too much specifics, but,
okay.
We talk about in a number of these podcasts not to use credit cards to buy real estate or, to do stuff like that, just because of the short amortization coupled with a number of things. But there are longer amortization, like unsecured lines of credit. They am out a little bit longer, and not credit card ones, obviously, but unsecured. And then there's secured lines, which obviously, both things are credit. They're just different forms of credit that are amortized at a different duration than credit cards. And as a result of the fact, the interest rates are typically differ, and the cost is obviously more sustainable. But there's just so many other variables in borrowing money off of a credit card itself, cash advances, and so on and so forth, that it becomes a situation that it just doesn't necessarily make a ton of sense or any sense at all. But there are ways to use credit, obviously, and I know Styron knows this because we've talked about this stuff before. And it is obviously using the general term of credit, whether it be financing or unsecured lines, etc., is the right way to buy real estate, and stuff like that. Though he knows that.
There you go. There you go, Styron. Yeah, Miss Divine. She's legit. She got all that amount of money on her on credit cards, which is crazy. But we don't normally we definitely don't recommend purchasing it any real estate by credit card.
No, not at all. And honestly, in all fairness, like I said, Divine is a unique scenario.
Okay.
I mean, and for anybody else other than her who's been able to orchestrate this, and she wrote a really long narrative and explaining it and everything and all her detail and just how well she manages the whole entire thing, that would be something I would advise the average client that comes to us to do, right? Like, she's a very unique situation that I successfully figured out to put this together and everything she did, and she did a great job. She's doing a great job of it. But I mean, again, I keep repeating, she's very specific about how she handles this. It's like a business for her. So
yes,
the average human being trying to go out and get 500 grand over however many cards, understand that I think the natural reaction would be what Styron would say, where, you know, people would just fall back on it. They get lazy, right? And that's why I'm saying I keep giving Divine credit, because it doesn't, you know, that's not what it looks like here. It looks like she's built it up. She's done incredible at managing it. She's very pragmatic about knowing the ins and outs of those particular, the creditors and stuff, for her to keep them open and not run into problems, which is why I keep seeing this accomplishment. But I wouldn't advise most people to do that for a multitude of reasons, one of which because I think they would fall back, because in a lot of cases human nature does get them to fall back on starting to live off of it, and then
yes,
it becomes a snowballing effect of problems. So typically speaking, if a client comes to us, you know, we'll get them set up with a rather significant card. By the time they're done, just have something that they can fall back on, right? Not something that they lean on, but something that they can fall back on for an emergency.
Emergency. That's what we preach.
If they're tight on liquidity, or if they're not prepared, this way it's almost like an insurance policy for them on the backside. And 99% of the time, that is more than enough, right? That they leave very, very happy, and it's all they need. And they don't intend on using it, but if they need to, it's there for downside protection for them, so it works. And that, you know, obviously we're not trying to, we're trying to teach as much fiscal discipline as we possibly can.
Yes.
In the most basic forms, right? So that people can understand the foundation, and they can expand into areas that they get more comfortable with once you get a firm grasp on it. And they understand why things work and how things work, etc. And you know, obviously, Divine has learned that art that she's doing on that side. She knows it inside and out. She's very well versed in that, right? And maybe a client, you know, one of the clients that we help over the course of time, we set them on their way on a sustainable path. They find another angle that they're be able to be exceptional at. You know, in the short term for us, we just want to build as much, you know, foundational fiscal education as we possibly can, so that people can make the right decisions from the door rather than playing from behind.
Yes, yes. Yeah, Jay. I mean, I don't recommend people getting a whole bunch of credit, and then because you know, it's human nature. You want to go and use it. You want to go rack it up. And all these years that I've seen credit files, I've seen people with personal credit card debt, $130,000, $140,000, and maxed out. Like, whoa, you got all this debt? It's crazy. Something happens.
Here's the problem, though. If you're not as disciplined as she is, the psychology of most people is that they're going to keep running up, and then there normally becomes a certain point when they're spending, right? It starts out with they're just going to spend a little, and they're going to pay it back,
yes,
and they realize they're not going to pay it back. And then they get to a certain point, and that point becomes the threshold for that person, right? So once they go over that, that's normally, it's a slippery slope beyond that. They're like, you know what, fuck it. I'm just going to run it out, and then I'm not going to pay it.
Yes.
Right? They normally commit to a decision after a certain line in the sand on those cards, and that commitment normally comes after a certain point in time. Then, like, you know, fuck it, I'm not paying it, and I'm not going to pay it back, but I'll run it up. I'll get every last bit of it, and then I'll figure out Plan B.
You don't know how many phone calls I got to go with people who call me that way. I'm just not going to pay.
That's why we like to just not even go down that rabbit hole, right? I mean, the right route to you know, I mean, there's a lot of reverse engineering that goes on in our process, right?
Oh, yes.
I mean, you have people that come in, and 90% of the time have to reverse engineer whatever they learned on the credit board that morning, much less what they programmed themselves from that credit board for the last 6 months, which 95% of it was fiction, right? And then once you get beyond that, then you start getting to the good stuff. You can start reverse engineering any just intrinsic and internally based stuff that they thought was wrong as far as how things work, and then you can start actually, rebuilding the psyche as well as the file, right, and letting them understand the right way to do things, the right way to borrow, the right way to do all this stuff. And it's a beautiful thing, honestly. It really is. It's a beautiful thing if somebody's really into wanting to understand, which a lot of clients are, and as we do more of these, you're getting more clients that are more interested in learning, and I think that's great because I think it's only helping them, certainly not hurting them. I got news for you. And being able to understand different aspects, and like we talked about today, with the interest rates, understanding why interest rates and how that draws back to your money market or your CD, or why people, why the stock market has so much money flooded in right now is because there's not any other place for it, right? Rates are low everywhere else, so you're going into the stock market, right? And rates not coming back. Of all these things that maybe you didn't understand before, we're trying to tie it all together, or at least do our best to tie it all together, right? If you progress from the first one we did to the one we're at now, a lot of them will lend to the next, right? We'll pick different details we go into more depth about, but if you watch the previous ones and any future ones, they'll all typically work in some degree of conjunction with the next, right? So you'll be able to get a good idea if you watch them all and you'll familiarize yourself with a lot of these basic principles behind the broader economy, which will allow you to make these decisions on a much more sustainable level, right? And you won't be, for lack of a better term, the sucker in the room, right? Correct. You'll be the one that'll understand the game before you walk in, and these people will stop looking at you like a mark, and they'll start showing you some respect, right? The respect that people naturally deserve, right? Correct. Not this bullshit where you walk into a dealership or you're talking to a mortgage guy and the guy's sizing you up, trying to figure out how stupid he thinks you are, right? So that he can start, all you are is dollar signs and register rings above in his ears, right? So it's just the right way that we're trying to teach so that people can really better themselves, at least from the perspective of understanding. I mean, it's great that we're able to clean it. I'm very grateful that we can clean people's credit, get them in the position, and align them with financing. But what I love just as much is the fact that we can educate them on what to look for, right? Correct. I mean, I really think that's the lasting impact outside of everything else we do that really sticks with a lot of the clients is the stuff that they learn when they're with us. Especially more so over the last couple of years because they're really trying to, right? They see that we're willing to provide that knowledge, and as a result, they're soaking up that knowledge, and that obviously is taking them in directions and opening them to things that they maybe not have understood in other walks of life or traditional walks of life that they're typically in,
Yeah, actually, Glenn Bias just said, just because you have all the credit doesn't mean you got to use it carelessly. 100%.
He's absolutely right. But I mean, for the record, in regards to Divine, she's not using it recklessly at all or carelessly at all. So, I mean, she's doing exactly as she should. But he's absolutely right, though. Generally speaking, broadly speaking, absolutely. The banks don't want to lend to people for the record, okay? The banks don't want to lend to people that look like they need it. They want to lend to people that look like they don't need it. So if you're maxed out and you're looking like somebody whose file is sweating, literally you can feel the sweat through the computer screen, you're the guy they're not going to want to lend to. I got news for you. They're going to find reasons not to lend to you. But if you're the guy that comes in with a clean file that looks like you're just trying to expand your base and you're trying to do it the right way, it's a different conversation. And it's a different approval. And it's a different approval amount, and it's different terms because the risk to the lender becomes less, or at least the perceived risk, right? So just remember that.
I got Styron just says, on the next live you all do, is it okay to invite others to the live? Yes, of course.
Absolutely. We always encourage that for
sure.
Share,
and share the video.
Existing clients of ours, just a lot of existing clients of ours, like I was saying earlier, we're trying to learn, we're trying to help. So they take it serious, which I fully encourage. I mean, I think the way to fully immerse yourself in this and get a full digestion of it is to understand everything that's going on.
Correct. You're not only getting like credit repair mindset, you're getting finance, real estate, vehicle, credit cards, business, economy, all that. You're getting an understanding from John. Thank you so much, John. Actually, Ms. Divine said, hey. And then First Genesis Project says, what is the best way to thicken a file?
I mean, if you're asking me personally,
let's take a look at when people come to us, because this is an example of best way to thicken a file. We had Michael Martinez from Texas, the couple, Blanca and Blanca
Oh,
Salazar, that couple, they came to us with bad credit. And then 3 to 6 months, they bought one car. By the 9th month, they bought another car. By the 12th month, they were buying a house. And then from there, you buy furniture. From there, you get credit cards. So that right there is a good way of how to thicken up your
I
file.
would have done if it was my choice. So I would have done it different. I would have had them do the house first, then the cars.
But this is the thing, Jay. People don't know their possibilities. People come to us.
They know. Listen, they know. And he's a great client. So is his wife. So this is not trashing.
I know, but I'm not trashing them either. But I'm just saying, when they come to us with one specific goal, because that was the whole thing with them. That we used to be like, well, you got the car, so what else you want to do? Like, oh, now I want to do this, and then they get the urge to be like, okay, cool, now I want to buy a house.
No. Their situation was the reason why his wife got into it because he first bought the house, then his wife. He brought the house was in his name, and he bought the house. Then his wife, we cleaned up his wife, and then they were going to buy another house.
Oh, okay.
What's that?
I say, oh, okay. I'm saying.
I'm always from the perspective of because of the underwriting requirements involved in the mortgage side of things, and how any added debt can decrease the amount that you can borrow on the house side. I'm always from the school of buy the house first. If that's the biggest, because it's always the biggest priority. It's always the largest cost. It's one of the few avenues of credit where you got to put money down, right? So you might as well get that knocked out of the way first and foremost for a multitude of reasons, most of which I just explained, and then knock out all the other ones after. And the other ones after, whether it be the auto loan or credit cards or whatever else, that stuff is you're talking about same-day approvals, same-day closings, right? I mean, it's a totally different process, so much simpler. And the debt you load after the fact in those situations, obviously you already have the house out of the way. So any debt you load after that fact, although I'm not saying you should just completely inundate yourself with debt, but any debt is not going to impact that largest purchase that you just had. And most people are in the business of flipping houses that come to us. Some are, most aren't. We just want to get in that house, right?
Correct.
So any credit if we can do it in an organized fashion, that's typically how we do it. But to answer the question that he had asked, I think he means how does he build out? How does he start to build out a thin file? If you've got nothing on there, it's going to be difficult to just go get a $50,000 car. So typically, what I tell clients, obviously in AU, after you get some primaries, there are primary services where you can add a couple primaries. Gizzy has a couple of them, where you can add a couple primaries, you can add an AU or so. You can also get some unsecured cards. There's Credit One, Capital One, First Premier, Merrick, Continental. There's a number of unsecured cards where you can start with low limits and they'll scale you up because they charge insane interest. But the problem is that the insane interest we're advising now, because it's just going to establish you an account, it's going to establish you an unsecured credit ratio, right? I'm not saying you should stay with those car companies forever. I'm saying you should stay with them for any longer than you have to. But in the early going, it's unsecured credit that you can obtain, and as long as the report looks good, but it's just thin and it's lacking, then effectively to a lot of these lenders, you're just like a recent college graduate, right? Or at least a recent high school graduate. You're somebody that hasn't really stepped into the credit markets yet, and that's how they're able to view you. So the approvals will be lower. The rates will still be high. It's not going to matter, but the objective of adding them isn't going to be for the purposes of using it. It's going to be for the purposes of establishing it, right? And then you can use that with the primary you add, and then the unsecured primaries that are edged yours with an AU on there. You'll get some depth to it. You'll get some age. You'll build it out, at least the age part of it from an illusionary perspective and the primary side of it. And then you can start to grow with it. You can go vertical with it, whether it be an auto loan to start off with, if that's what the goal is. Or in that case, I believe FHA requirements, you only need 2 or 3 primary accounts. So at that point, you should be good for the mortgage if you can document income. And it'll allow you the opportunity to just grow it from there. You need to have at least a reasonable base of things to really start to establish. So, I mean, in order to build it exactly, I would build it exactly around a particular type of credit, whatever that first primary, angle would be. But I don't know what this particular individual's is, so I'm not sure what that specific answer is. But I would say, broadly speaking, what I just described is how we would build it out.
Okay.
And we don't do again, to go back, I don't ever advise people to use secure credit cards. It's not. I've already beaten up on that whole theory, so I'm not a fan of it. There's really nothing about it. I'm not huge on the self-lender things, just because they report as loans, they don't report as unsecured credit. So you're not getting the factor that you would get with the unsecured credit ratio and the subsequent points that come with it if you're somebody that doesn't have it. And you're not going to get a ton of points from them reporting in most cases to begin with. You're going to get age, and in some cases that age is limited. So it just becomes an additional count on the report. So, that's kind of the reasons why we do it the way we do it.
Okay. Freddie asks, hey, John, what do you think about bank stocks? Good time to buy?
It would have to be specific to the bank, and I think it's really, really still kind of early. If anybody's been listening knows that I called out a couple back in February. Like Discover was trading really low. Capital One was down at one point around $20 a share. It's back up significantly high now. This was over the last 8 to 12 weeks, right? Discover was down around $30 a share. These are typical markets, $80, $90, $100, right? So they were trading at a very small, percentage. Broadly speaking, you're talking about like Bank of America, Citi, Chase. They're all trading at a huge discount. I'm personally not, because I don't see interest rates going up. And until they, that's normally what's going to drive. I mean, obviously they sold off exponentially because of the potential, the assumed potential of losses, right? Meaning like the perceived losses that people aren't going to be able to pay. We haven't really been able to see that because of the stimulus money coming in and all the mortgage deferrals and all these other things yet. So I think it's a little early still for the banks, not to mention banks like Chase and Amex and stuff. They've cut out their business lending for the entire year. So imagine extracting revenue, that amount of revenue from your top line. I mean, it's going to really impact earnings exponentially when you stop your business lending, right, outside of PPP loans, which is only earning almost nominal interest. So me personally, somebody asked me about the airlines last week, and I said they were overpriced and they've dropped subsequently $10. I'm not big on the banks right now. I think there will be an opportunity, but I'm not personally big on them right now for those reasons. I just think it's too early to see, because I don't think we've seen the full dust settling from just because there's been so much stimulus in the market that we don't really know the level of defaults yet of what they're going to see, whether it be on the mortgage side, the credit card side, the auto side, and I don't think we'll see that. We'll probably won't cycle that out towards the end of this year, and that could put more pressure on it. But I mean, it's a forward-looking mechanism, so I don't know. I don't have that. That's where I'm at. I'm not a huge bank stock guy unless I see huge anomalies, but I'm not big on it right now anyway.
Okay. Miss Divine said, I handle my brother's account for $300,000. So that's another thing she said.
That's what I said. This is definitely an area of expertise for her. She knows what she's doing.
That's very good, Miss Divine Brown. Good for you. Okay, John, we are at 2 hours, 7 minutes, just like that. People always come at an hour and a half and they start asking all these questions. Okay, now Freddie just said, you seeing mortgage loans? Oh, okay. Hey, John, you seeing mortgage loans over 50% DTI getting approved since we are gradually reopening the economy?
Do I see loans over 50% DTI? No, I don't. But I was using, if you remember, 55% was February, right? And that was roughly where things were at in February. Right now, things are kind of on a little bit of a sliding scale. Nothing's really set as far as, but they are, FHA does still have certain requirements, and that doesn't, if you go back to one of the previous podcasts I did before, we talked about how, a lot of lenders that didn't have a lot of, maybe their credit wasn't as good with the people they were reselling as far as the percentage of successful loans they've resold. So, they were running into liquidity issues as far as they were only being able to fund loans, FHA loans that went to 700s. Remember that?
Yeah.
So, as a result of that, there are still tons of lenders that are doing it by the same DTIs, right? It's just they have better relationships with the people they're reselling the loans to, and the success of their loans is good. So the relationship with the people they're selling them to isn't as questioned, and as a result, you're not running into the same issue. But to answer his question, generally speaking, on a conventional side outside of FHA, no, I think that it'll scale back, and I think it'll scale back rather significant. I think 50 um, is kind of a line in the sand. I know back in when shit really hit the fan after 08, 09, I think we got back to like 42%, something like that at one point. Do I think we're going to get that low? No, because I don't think there's that level of hysteria. But I do think, though, we will see. Yeah, I think 50 is a good line to use. As far as if you're trying to do the numbers on a mortgage, I think 50 is a good one to use. I wouldn't go higher. I don't think it's necessary to go low, but I think that would be the right number to use. And if it deviates, it's going to be ever so slightly. But you got to figure, though, there was Quicken was doing loans into January, into February. They were pumping out loans at like 56, 57% debt to income, which I thought was insane, and it is insane. But at the same time, now getting back to 50 or even a shade under, that's a pretty big pullback.
Yes.
Right? And if you think about the fact that you're talking about 7% of somebody's debt to income ratio, that's 7% of the gross income, right? So if you go from 56% down to, let's just say 48%, that's 8%. If you make 10 grand a month gross, that's $800 of payment you just extracted out of there, which effectively is the equivalent of 3.5%. It's about $230,000 of buying power. That's significant.
Correct.
Right? So but put that in the broader scale like we talked about earlier. It's going to force people to get approved for less because debt to incomes are going to come down too, right?
Yes, correct. That's why you got to have that debt to income, that debt, the lowest as you could possibly get it.
Yeah, that's just not human nature, unfortunately, though. So that's why it's always, it's always run up to like the nose, unfortunately, which is why when you see situations like this where debt to incomes come down and down payment requirements go up, see house sales slow down, right? And for obvious reason, right? Now, right now, like I said before, right now you're seeing houses sell in the summer because there's so little supply and there's just enough functional demand, right? But at the same time, I mean, it's nowhere near where a typical summer market would be. Look it up. I mean, look up sales last year in the summer market.
People were buying like crazy. I would see selling here, selling there. Not now.
You mean you're talking about this year?
Yeah. I mean, last year, the couple of years, you see your realtors.
In the summer, that's what I'm saying. In the summer, it's typically the summer into the early fall into backed out from the end of spring. I mean, it's normally a feeding frenzy, right?
Yes.
It's just obviously with everything going on here right now, it's just indicative of the broader issues that are going on. But to answer Freddie's question, I think I would use 50. That's where I'm just typically rounding out when we're doing clients' files and we're trying to back into a form. We're using 50 as the line. If it scales back significantly more than that, I'll let people know on another cast. But I think that's a safe number to use conservatively, I think, if you're trying to do the math on your own. Okay.
All right, Jay. It's 2 hours, 12 minutes. I know you're tired. It's Monday. Monday's always rough for us. It's crazy. Okay, then Freddie just said the conventional loan we are looking at is more than 50% DTI with 20% down, but FHA loan was 57% with 3.5 down.
Yeah, I knew FHA was tight. That's what I just said. I don't know what the conventional was because that's a number that can be teased. Right, that's not a subsidized loan from the government like the FHA. FHA is fixed on its rules annually. So I knew, that's what I said earlier, I knew that the FHA was where it needs to be, but the conventional, I don't, that number can be moved around, and that number can change on a dime too. So they can change that whenever they feel like it, because it's specific to the entity and whoever they're reselling to. So, I think we talked about his stuff in depth, though, about how I think he wants to do conventional anyway. I think is what he told us before. So sounds like he got that in his question answered, though.
Okay. All right, Jay. Thank you so much, everybody. Clap for Jay. Had about 10 to 15, 18 people log on. Thank you so much for people logging on. Again, if you find this education, if you find this is valuable information for you, you're learning, please, the best way you could do is share, like the video, subscribe, hit the notification bell. I still have a lot of credit repair results videos that I need to make. As you know, my wife is working. I take care of my daughter, so it's a lot of stuff to do. That's why I haven't put out content, but I've been putting out content on Instagram so you guys could see that we still giving people results and we're still here helping you guys out. And every Monday we come on 6 p.m. Eastern Standard Time to educate you guys, let you know, answer all these questions, and you guys get educated. Anything else you want to say, John?
No.
Okay. Well, thank you, John. Appreciate you, and speak to you tomorrow.
You got it.
Take care. Bye-bye. So, mi gente, you already know. Thank you, John and Giz. Styron. Words can never give you both the appreciation for y'all time. No problem. Listen, John, he's a beast. He wakes up 5 o'clock in the morning. He doesn't go to bed until 9 o'clock, 9:30, and he is a workaholic. But no, he's the man. That's why I put him on here so he could just talk. But yeah, Fat Boy, you missed the whole podcast, but it's all good. It's only 2 hours and 15 minutes. Thanks, John. No problem. Anyways, my people, gotta go. Let me, like I said before, please like and share the content. Like and share the video. I'm working on having a better setup pretty soon. I already got John a microphone, so you're gonna be able to see John and hear him clearly the next coming weeks. So thank you so much to everyone. Let me end up with the famous GizzyCredit team song. #GizzyCredit. Who's here? Who's here? GizzyCredit. Oh. Anything you want, then you can get it. You just have no don't be scammed, because they know the credit. GizzyCredit. Hey. Anything you want, then you can get it. Don't be scammed, hey. The credit. Go, Daddy. Go, Daddy. Go. GizzyCredit. Bella, 19 months old. You no longer gotta look pathetic. Oh, Gizzy. Hey, go ahead, Bella Rain.
Woo!
Oh,
Go.
Oh,
Go.
Hey. Don't get scammed.
Don't be scared. Don't be scared.
Go ahead, Bella Rain. Hey.
Raise the roof. Raise the roof.
Hey.
Raise the roof. Raise the roof.
Don't be scammed. And time is money.
Woo!
Get
Go
that cash.
Go.
Just get it fast. Hey. All right, my people. See ya later. Bendiciones to all. Thank you for logging on. Appreciate you. See ya later.
Bella, say bye-bye. See you later.
Take care, my people. Thank you.